Hello everyone, let's start with revision of amalgamation, the most important, and so many students were asking for this revision. Today I'll be covering exhaustively, like each and every concept I'll be teaching you. PC calculation, merger, purchase, selling company, ICA steady material sums, everything I'm going to teach along with the sums. You are going to have super duper confidence after this session. Okay, get ready. Let's start quickly. Amalgamation of a company. Let me give small background of this. Okay, amalgamation. The word amalgamation, actually there are three terms which you have to remember. One is amalgamation, other one is absorption, other one is external reconstruction. Other one is what? External reconstruction. What I mean by amalgamation, sir? See, for example, there are two companies, A Limited and B Limited. These two companies gets liquidated to form a new company called AB Limited. This is called as what? Amalgamation. So minimum two companies should liquidate to form a new company. Then what do you mean by absorption, sir? See, one existing company takes over one more existing company is called as what? Absorption. For example, Reliance Industries Limited is taking over Adani Limited. Both are existing company. One existing company takes over another existing company. Correct? So one company gets liquidated. Here how many company gets liquidated? Two company gets liquidated. So liquidation is mandatory for amalgamation, absorption, as well as when I teach you external reconstruction, there also you'll see what? Liquidation. So two or more company closed and one new company is formed, that is called as amalgamation. One company which is an existing company takes over the another existing company, that is called as what? Absorption. External reconstruction means, for example, okay, same Infosys Limited is there. Infosys Limited, okay, they are getting, like, they are getting liquidated and they are starting something called as a new Infosys Limited. Means one existing company gets liquidated and one more new company will be formed. Okay, so one existing company closed and a new company is formed. One existing company liquidated and a new company is formed. A new company is what? Formed. Therefore, in all the cases, one thing you are seeing in common: liquidation, you are saying common. Therefore, for amalgamation, absorption, external reconstruction, liquidation is mandatory. Here how many companies are involved, sir? Here three companies are involved. 1, 2 and third company. Three companies are involved. Here two companies are involved. Here also two companies are involved. Point number 1. Here liquidation is mandatory. Here also liquidation is mandatory. Here also liquidation is mandatory. So in everything what is there? There should be something called as what? Liquidation. Correct. Point number 2. Once liquidated, there is only one new company, there is only one existing company, there is only one resultant company. Therefore, in everything there is one resultant company. Here there is one resultant company, here there is only one resultant company after absorption. Here also there is one resultant company after external reconstruction. So only one resultant, and here also only one resultant company. But here story is, the resultant company is a new company. Here the resultant company is already an existing company. Okay, resultant company means the one which is alive after the liquidation. Correct? And here also one resultant company, but here resultant company is a new company. Since there is a common point, there is liquidation is mandatory and also the resultant company is only one company. Therefore, accounting for all amalgamation, absorption and external reconstruction remains same. That's why the word amalgamation, whenever they talk in AS 14, the word amalgamation includes absorption and external reconstruction, because there is something common in this. Therefore, accounting also will be common for this. So when I teach accounting for amalgamation, the same is applicable for absorption and external reconstruction. Sir, whether we have to bother in exams, whether we have to find that absorption, external reconstruction, whether accounting changes? No, nothing changes. Same accounting only, because two things are very, very common in this. One is liquidation is common, and also resultant company should be a one company. That should be a new company or existing company, but it should be only one company. Based on this, accounting will start. So to start AS 14, either it should be amalgamation, absorption or external reconstruction. From now onwards, even if I say for absorption, amalgamation, even for external reconstruction, if I say amalgamation, it means accounting is same. So I cannot call every time similar, like, separately. So everything put together, I'm going to call it as what? Amalgamation. But in sums, whenever I when we solve the sums, I will teach you some important points how to identify, but accounting remains same. Clear? Sir, how many sums we are going to solve, sir? Nearly I'm going to solve 20 plus sums. Everything I'm going to solve. ICA study material, all important sums I'll be solving, and one new sum they have included in the recent ICA study material, that also I'll be taking a super question. I love that question. Clear? Listen, sorry sir. Okay, what we understood is, okay, there is amalgamation, absorption and external reconstruction. Okay, fine sir. Then accounting is different, sir, or same for all the three categories. Clear? See, point number one, sir, how many methods of accounting are there? They are telling methods of accounting for amalgamation. When I say amalgamation, I am telling what also, external as well as absorption also. So accounting, there are two methods of accounting. One is called as pooling of interest method, other one is called as purchase method. Said when pooling of interest method should be adopted, when we have to apply that pooling of interest method, when the amalgamation, if it is in the nature of merger, when the amalgamation is in the nature of merger, then we have to apply what method? Pooling of interest method. No sir, when the amalgamation is in the nature of purchase, then we have to apply what method? Purchase method. Sir, when we will call like one takeover, absorption, actually something is happening. No, when we will call something as amalgamation in the nature of merger. When I say amalgamation, repeatedly I'm telling it can be absorption, external reconstruction. Commonly we will talk it as amalgamation. When we'll call an amalgamation as amalgamation in the nature of merger, sir. If for that we are having doubt, sir, when we'll call an amalgamation is an amalgamation in the nature of merger, say yes or no. So they are telling, when we are having doubt whether we'll sit and cry or we'll ask AS14. AS14 is the governing standard for that. We went to AS14. AS14, please tell what you mean by amalgamation in the nature of merger. When we can find amalgamation in the nature of merger, because amalgamation in the nature of merger, there is a different method you are telling. What is that? Pooling of interest method. And amalgamation in the nature of purchase, you are telling there is a separate method. What method? Purchase method. So methods means accounting also will be different. But my question is how to identify whether it is a amalgamation in the nature of merger or amalgamation in the nature of purchase. Then who is helping us now? AS14 helps. Arey Sathya, don't die. I will tell you. If I am the person who is telling the method, don't I tell you that when I will call something as amalgamation in the nature of merger, then we were like, AS14, please tell how can we identify? AS14 says, Sathya, I will tell you certain condition. 5 conditions I will tell you. For all the 5. What is that? If all the 5 conditions are satisfied, then it should be called as amalgamation in the nature of merger. Out of 5, 1 is also not satisfied. Then what AS14? It is not an amalgamation. AS14 says, I will bomb you and I will finish your story. Array, if 5 conditions are satisfied, first it should be amalgamation, absorption, external reconstruction. Then only should ask me what? Which method we have to apply. Correct? For applying the method, you are asking whether it is in the amalgamation in the nature of merger or purchase. Okay. So they are telling, if all the 5 conditions, whatever I say, if it is satisfied, then it is amalgamation in the nature of purchase. Apply what method? Pooling of interest method. Apply what method? Pooling of interest method. Out of 5, even if 1 condition not satisfied, 4 satisfied, sir, predominantly satisfied, sir, then it is not called as amalgamation. It is not called as amalgamation in the nature of merger. It is not called as amalgamation in the nature of merger. Still, it is amalgamation only. Many people are mistaking that. Like, if 5 conditions are not satisfied, then it is not amalgamation. It is amalgamation only. Some other method we have to apply. Clear? So, if all the 5 conditions are satisfied, then we have to apply one method called as what? That measure, and all the 5 methods are satisfied, then amalgamation is called as amalgamation in the nature of merger. Then the method is called as what method of accounting we have to adopt, sir? Then we have to adopt one method called as what? Amalgamation in the nature of merger. Now we are asking AS14, come on, come on, tell me. Like that we are asking. Amalgamation. AS14 says, when I say 5 conditions, all the 5 should be satisfied. If all the 5 conditions are satisfied, merger, apply pooling of interest method. Therefore, what is the first condition? AS14 we are asking. AS14 says, there are 2 companies, correct? One is a selling company, correct? I am not let me do like this, okay? There is a selling company and we are purchasing company. So 5 conditions satisfied means then it is called as amalgamation in the nature of merger. First they are telling, all the assets and liabilities of what company? Seller company. If it is becoming assets and liabilities of our company, then okay, then immediately amalgamation in the nature of merger. The AS14 says, I will speak superly if you tell like that. I said 5 points should be satisfied, not first point. Check for 4 points also. Okay, sir. All assets and liabilities of what company? All assets and liability of transferor company. Selling company should become assets and liabilities of what company? Purchasing company. Second, they are telling there are owners. No, who are owners? Equity shareholders are owners. Okay, minimum 90% of the equity shareholders should agree to become the equity shareholders of whose company? Our company, purchasing company. Okay, so minimum 90% or more. What is that? 90% or more of equity shareholders should agree to become our equity shareholders. of purchasing company. Sir, already they are holding some shares, sir. Then excluding that, 90% should become our equity shareholders. Clear up? And third point they are telling, these people who have agreed to become our shareholders, correct? 90% of the equity shareholders of selling company agree to become what? Shareholders of purchasing company. For them we have to settle. Freely they will come. No, we have to pay something. So the amount of consideration, which we'll call it as purchase consideration, the purchase consideration which we have agreed to pay to the equity shareholders who have agreed to become our equity shareholders, to those 90% of equity shareholders, we have to settle only through equity shares. Means the intention of amalgamation in the nature of merger is, if they are owners in that company, here also let them be owners, here also let them be owners, correct? So out of 5, first 3, all assets and liabilities of what? Seller company should become assets and liabilities of purchasing company. Number 2, they are telling 90% or more, okay, of equity shareholders of which company? Seller company should agree to become the equity shareholders of what company? Purchasing company. Third, they are telling the purchase consideration to the people who have agreed to become our shareholders. No, it should be only through what? Equity shares. Sir, but when I divided, no, fractions we are getting. For that fractions you can give cash. No, nothing to worry, because shares cannot be issued at fraction. Point number 4. Sir, once they become the owners of the company, we will also be there. These people will also be there. So they are also owner. We are also what, sir? Owner. Okay. Now they are telling, okay, sir, that business, what we have to do? That business should be continued by the purchasing company. So business of the selling company or transferor company should be continued by the transferee company. Okay. Fifth point they are telling, when you are bringing assets and liability, every assets and liability should be brought at what value itself? Book value itself. No changes should be made to the book value. No adjustment should be made to the book values of what? Assets and liabilities of which company? Seller company, when it is incorporated in the books of purchasing company. Sir, but my policy is different. No, sir. For example, inventory you are telling to bring in the same thing, correct? But my policy is different. He is following FIFO, but we are following weighted average, sir. It will be a clash of accounting policy. Then accountancy is giving relaxation age 40. Oh, okay. Then don't die. What I will tell you, generally you have to bring it at what value? Book value itself. No need to make any adjustments. Okay. But if there is different accounting policy to ensure uniform accounting policy, then you can make the adjustment. Other than that, if you touch the numbers, then it is not called as what? Amalgamation in the nature of merger. It will go to amalgamation in the nature of purchase. Then you have to apply what method? Purchase method. Therefore, to apply this pooling of interest method, it should be amalgamation in the nature of merger. To be amalgamation in the nature of merger, how many conditions? 5 conditions. Number 1, all assets and liabilities should be should be incorporated in the books of what? Say purchasing company, correct? Second, they are telling 90% or more of equity shareholders of transferor company should become assets and liability. That is equity shareholders of which company? Purchasing company. To them, we have to pay the PC only in equity shares, unless fractional shares are there. For that fractional shares, we have to issue cash. We can issue what? Cash. Fourth, business of seller company should be continued by the buyer company. And fifth, they are telling no adjustment should be made to the book value of what? Assets and liabilities of seller company when it is incorporated in the books of purchasing company, except to ensure uniform accounting policy. We will run through quickly. So sometimes what they'll ask, no, this itself they'll ask for theory. That's why I'm telling you this. Clear? Please listen to me, ma. Okay. So amalgamation in the nature of merger is an amalgamation which satisfy all the conditions, all the 5 conditions. Don't forget that. Clear? All the 5 should be satisfied. Then only it is called as what? Amalgamation in the nature of merger, correct? So point number 1, all assets and liabilities of transferor company should become assets and liabilities of what? Transferee company. Next, shareholders holding not less than 90% of the face value of equity shares of what company? Selling company or transferor company should agree to become the shareholders of which company? To the shareholders of transferee or buying company, that is purchasing company. Clear? Sir, already we are holding some shares before amalgamation. We are holding, transfer is holding, our subsidiary or nominees are excluding that 90% they have to become. Clear? Okay. The consideration for the people who have agreed to become the shareholders of transferee company, purchasing company, for them we have to settle only through what? Equity shares. Should be settled only through what? Equity shares. It should be dissolved only by what? Equity shares. Except cash can be given for what? Fractional shares. So the business of the selling company is intended to be carried on by the purchasing or transferring company. No adjustment should be made to the book values of assets and liabilities in the books of what? Purchasing company when it is incorporated. The assets and liabilities of selling company. Correct? But you can change to ensure what? Uniform accounting policy. If all the 5 conditions are satisfied, come on, be ready, don't sleep, come on, focus, put your phones down, listen to me, kada. So if all the 5 conditions are satisfied, then they are telling, okay, you are having an open gate to do what? One method called as pooling of interest method. What method? Pooling of interest method. Sir, what is the accounting when it comes to pooling of interest method? Immediate, I will tell. Listen, kada, ready? Listen. After satisfying 5 conditions, it becomes amalgamation in the nature of merger. Once it is there, now pooling of interest method. Sir, how to do accounting when it comes to pooling of interest method? Point number 1, AS14 is applicable only for what company? Purchasing company, transferring company, not to the transferor companies, not to the selling company. AS14 exclusively applicable for what company? Purchasing company. AS14 is not applicable to selling company. Sir, no sir, it is not applicable. Then what is applicable, sir? A general closing of the books, how we used to do. Correct? You remember in foundation or colleges, wherever we were learning, partnership dissolution is there, where we used to prepare realization account, that this and all. Correct? Same thing we are going to follow. Everything we are going to close. That I will teach you last. Clear? AS14 is applicable only for the purchasing company. Is applicable only for what company? Purchasing company. Sir, okay. Sir, what we have to do now? Till I say, everyone, those who are watching also, just listen to me. Just listen to me. Just think like purchasing company. Don't think like seller company for some time. Just for some time. Clear? Point number 1. Sir, okay, we are purchasing company. We have to pass journal entries. No, sir, we are getting assets, liabilities. We are paying something. Everything we are going to pay. No, for that we have to pass a journal entry. We have to pass a journal entry. How to pass a journal entry? How to account it? Clear? So all the 5 conditions satisfied. What method? Pooling of interest method. Under pooling of interest method, very easy they are telling. What is the first thing they are telling is, all assets, all liabilities, including all reserves of seller company should be taken and it should be incorporated in our books of accounts. Sir, reserves also we have to bring. Yes sir. Now you'll ask, why sir reserves also we have to get under pooling of interest method? Accountancy says, Array, their owners are there na. They went just like that, they went outside, they have come to our business, they have come to our business. From the company, everyone, if they are coming to our company, and these people after coming also, they are continuing the business under a new brand name or the existing name. Correct? They tell me, if everyone comes to here and they are also what doing that business, whether they will leave the reserves or they will not leave the reserves, or they will not leave the reserves. Reserves will be there when corresponding assets you are incorporating. Reserves also should be there, and the same owners are there. Correct? Then sir, what is the difference, sir? There in the old building they may be doing it. Okay, to understand I'm telling you. In the old building, same set of people, same business they are doing. Instead of that, they are coming to new building and they are doing the same thing. No sir, what is the difference, sir? It is just like changing the house for rental purpose. Correct? What difference is there, sir? Correct? Then accountancy says, you people are perfectly correct. You people are perfectly correct. There is no difference. There is no difference. Even before amalgamation also, these people are the owners, they are doing the business. After amalgamation also, these people are owners, these people are what? Doing the business. Therefore, AS14, accounting sees amalgamation in the nature of merger as a non-event. Means it is not even considering it as a particular exclusive transaction. Clear or not clear? It means accountancy sees same set of people purchasing their own business. Same set of people, they are purchasing the own business. That's why goodwill or capital reserve will not arise at the time of what? Amalgamation in the nature of merger, because accountancy sees they are paying to themselves. How can they pay to themselves high or more? After I pay to myself, if I pay more, can I call goodwill? If I pay to myself extra, it is called as goodwill, not a goodwill. Even if you call it as goodwill, it is called as self-generated goodwill, because you are paying to yourself. Entry allowed or not allowed? Not allowed. Correct? Sir, if I pay more, what is the story? Sir, I will tell you when I start. Don't worry. Clear? So, they are telling, when I pay to myself, if I pay extra, what is the story? Sir, I have a question. I will teach you. Conceptually, I will teach you. Even though it is revision, I will give you 200% clarity. In majority of the cases, you will love everything. Clear? You will love amalgamation itself. Just to focus. Okay? So, okay, sir. Under pooling of interest method, what are the points we have to remember, sir? Come on, sir, quickly, sir. All assets should be incorporated at their book value. All liabilities should be recorded at book value. All reserves should be, incorporated at what value itself? Book value itself, subject to adjustment. Subject to what? Adjustment. When I teach, I will tell you. Clear? Sir, reserves also we have to bring. Yes, same owners are there, 90%. Predominantly people are here, so we have to do. Sir, but what happens, sir, if few people, everyone need not to come here, no, sir. Minimum 90% they have to achieve. But 100% also they can come. Less than 100%, but more than 90%, sir. Correct? Yes, sir. For example, sir, 95% of the people they are coming, 5% they are not interested to come, sir. Then what we have to do? We have to settle them and we have to send home. Clear? So that is the story. Point number 1, when it comes to amalgamation in the nature of merger, pooling of interest method. Under pooling of interest method, point number 1 is bring all assets book value, bring all liabilities book value, bring all reserves at book value, subject to small adjustment on particular place. Clear? So identity of the reserves of the seller company is preserved in the what? what? Books of purchasing company. It will not be changed. Clear? No goodwill or capital reserve will arise at the time of what? Pooling of interest method, amalgamation in the nature of merger. Sir, what is the journal entries we are going to pass, sir? Shall I teach you very quickly? Listen to me. So after I teach you the concept, then I will come to PC calculation. Then I will come to what calculation? PC calculation. Okay. Point number 1. Amalgamation in the nature of merger. Top 3 journal entries are there. Any sum? First 3 entries you have to pass. It will be very easy. Point number 1. What is the first entry they are passing? Business merger account debit to liquidator of vendor company. It is in the whose book? I said no. AS14 is applicable in the books of what? Purchasing company, not in the books of what? Selling company. So purchasing company is also called as what? Transferee company. Clear? So in the books of transferee or purchasing company, under which method? Pooling of interest method. What is the first entry they are passing? Business merger account debit to liquidator of vendor company with the PC. PC means purchase consideration. PC means what? Purchase consideration. Okay. Second entry what they are passing is, they will bring all assets, they will bring all liabilities along that. Under pooling of interest method, reserves also they are bringing. No. So that also you have to do. Then you have to reverse. Okay. So assets account debit, liability to business merger, reserves. Why they are passing this entry? Give me 1 or 2 minutes time. I will explain you the logic also. Then when you settle the liquidator of vendor company, liquidator to whatever you are settling. Okay, sir, what is the logic behind this? Ready for the logic? Listen to me. For example, if you are purchasing an asset, what is the journal entry? Asset account debit. Come on, asset account debit to. If you purchase on credit, what you will write? Asset account debit to what? The supplier name. Correct? Now we are purchasing one asset, group of assets. Correct? So net assets account debit to supplier. Means assets, sundry assets account debit to supplier. Whether we are purchasing only asset or business also we are getting business. When I purchase business, whether I am getting assets or liability also. Correct? So assets account, all outside liability account. This will call it as net assets. This will call it as what? Net assets. So this time you are not getting only one asset, you are getting the business. So you are not getting the asset, you are getting the net assets. So net assets account debit to supplier account. Come on, net assets account debit to supplier account. Correct? Their net assets means what? You are purchasing the business account debit to, if all the 5 conditions are satisfied, you can use that to give the clarity to the people. This is in the nature of what? Merger. So business merger account debit to, here supplier or that fellow is what? Closing the business. That fellow is closing the business. Which fellow? The selling company. So I am writing it as what? Selling company is called a selling company or vendor company. Correct? So business merger account debit to vendor company. Come on, business merger account debit to vendor company. Clear? But there the word is different. No, sir. Business merger account debit to liquidator of vendor company. Why, sir, liquidator they are using? Because they are liquidating. If you are thinking like that, it is wrong. Means if you are, see, it is payable, no, to the vendor company. To whom it has to be paid? You will go like, no, you will go with 100 crores cash bag. You will put it in the road or in the entrance of the company. You will go back, or you will hand over to a particular person. We will hand over to a particular person. There will be a person who will be appointed at the time of liquidation. That person can be called as what? Liquidator. So that's why when we write, we'll write it as what? Liquidator of vendor company. That is the logic for what? Business merger account debit to liquidator of vendor company. So first entry is what? Business merger account debit to liquidator of vendor company. Clear? So what is this, sir? See, you are getting an asset. Okay, generally asset should be, when you are incorporating, it should be recognized at cost. What is cost? What you sacrifice is cost. What you are going to sacrifice on amalgamation, purchase consideration is what you are going to do. So against this asset we are going to pay. Correct? PC. Paid up, payable. To whom it is payable? Liquidator of vendor company. Therefore the entry is business merger account debit to liquidator of vendor company, which is a payable account, liability account, just a temporary liability. Clear? When you settle, it will be cancelled automatically. In ICA for merger also they will use what? Business purchase only. For merger also they will use what? Business purchase. That's why when you see in ICA sums, majority instead of using business merger, they will also use what? Business purchase account. In exam you can use business purchase itself, nothing to worry. Clear? So first entry is for recording the PC. Come on, first entry is for what? Recording the PC. So first entry number 1, business merger account debit to liquidator of vendor company. Second entry is, okay, you are passing the due entry, everything is fine. Now in reality you have to get all the assets, liability, reserves you have to bring. No, so bring the assets. Okay, so bring all the assets. Their assets should be incorporated in our books as assets, so debited. Clear? Assets will have what balance? Debit balance. Everything at what value? Book value. Their liability should become our liability. Bring it at book value. Liability should be credited. Liability should be credited. Are yes or no? So assets of vendor account, vendor company is incorporated in our books. Liability is also brought. Along with the liabilities, I told you to bring what also? Reserves also. Book value only, but small adjustment. Book value only, no changes, but small adjustment we will do. Then we will write the amount. Correct? Sir, okay, sir. Then assets we brought. Correct? assets, liability and reserves you bought. Means net assets bought, no sir, business we are getting it, no, even after bringing the business, still it is business, still assets received, received, correct? So then this business merger means, what is the meaning of business merger in the first entry is, we are going to receive the business, we are going to acquire the business, we are going to get assets, liability and reserves of that particular selling company. For that you are passing the due entry. Now after getting assets, liability and incorporating reserves, still it is going to receive or received. Even after incorporating assets and liabilities, still you will say it is receivable or no more receivable or no more receivable. Therefore the debit, since it is no more receivable, I am going to reverse it, correct? That's why business merger is reversed in the second journal entry, clear? So first entry is business merger account debit to liquidator of vendor company. Second entry is what? Assets account debit, liability account debit, reserves account debit. After getting the business, we have to reverse this business merger, clear? Now sir, okay, this is cancelled automatically, assets and liabilities are there, correct? Reserves is there. This liability we have to settle, no sir, yes we have to settle. This liability, liquidator of vendor company, the PC should be settled, no? So when I settle this, liability will be reversed, so it should be debited. I can settle by equity shares, preference, debentures, everything I can settle. But when it comes to equity shareholders, for the 90% of the equity shareholders who are agreed to become the shareholders, no, for them we have to exclusively give what? Equity shares only, clear or not clear? But if it is amalgamation in the nature of merger, no, for the equity shareholders you can give anything. If it is amalgamation in the nature of purchase, since it is amalgamation in the nature of merger, for equity shareholders, that 90% we have to settle only through what? Equity shares. Only through equity shares. Cash can be given for fractional shares. Sir, the people who did not come now, who are creating problem, who are not accepting to become our shareholder, they are called as dissenting shareholders. For them what we'll do, you settle by anything, clear or not clear? See, point number one. Now what is PC, sir? PC is whatever you pay to equity shareholder. The PC point is common for both merger as well as purchase. PC means whatever you pay to equity shareholders and preference shareholders, clear? When it comes to amalgamation in the nature of merger, for the equity shareholders, PC should be settled only by way of what? Equity shares, except cash can be given for fractional shares. Except cash can be given for what shares? Fractional shares, clear? But amalgamation, if it is in the nature of merger, it is not important. We have to give only through equity shares. You can issue preference shares, you can issue debentures also. You can issue what also? Debentures, cash, anything you give, clear? That can be taken into consideration. Any security can be given. When it comes to preference shareholders, what you pay to equity and preference put together only we'll call it as PC, clear? But when it comes to merger, equity shareholders, we have to settle by equity shares, correct? For preference shareholders, in case of merger or in case of what? Purchase, you can give anything to them, clear or not clear? It is not important they have to get only preference shares. You can give anything, clear? Only difference will be there in case of merger. That's why sums and all, if you see merger, equity shareholders will be settled only through equity shares, except for fractional shares. But the same sum if you see for purchase, okay, amalgamation in the nature of purchase, for equity shareholders they'll give everything, clear? Whatever they want to, whatever is given, that will be considered for PC. I'm making it very clear. Listen, small points I'll tell you. To decide amalgamation in nature of merger or not, second condition is there, no, 90% of the shareholders. That shareholders means equity shareholders, not preference shareholders. Clarity number two. When it comes to PC calculation, what you pay to equity shareholders and preference shareholders, both are considered for PC. Point number three, for PC, okay, what we pay to equity and preference, I said no. For equity shareholders, in case of merger, only equity shares will be given, and for fractional shares, cash will be given. But for the same equity shareholders, if it is amalgamation in the nature of what? Purchase, whatever you give to them, securities, equity shares, everything can be considered for what? PC calculation, clear? But what you pay to debenture holders, okay, what you pay to debenture holders is not PC. Liquidation expenses paid by the purchasing company on behalf of the selling company is not a PC. Clear? On formation expenses is not PC. Nothing is considered. What you pay to equity shareholders and preference shareholders are only considered for PC. Equity shareholders, if you give debentures also in case of amalgamation in the nature of purchase, that is considered as PC. But for debenture holders, if you are giving equity shares, then it is not what? PC. So when it comes to amalgamation in the PC calculation, when it comes to what calculation? PC calculation. For equity shareholders in the nature of purchase, you can give equity shares, preference shares, even debentures if it is given also, it will be considered for PC calculation. Same is the case for what? preference shareholders also. But for debenture holders, whatever you pay, even equity shares if you give also, it is not considered for PC calculation. Clear? I'm making it very clear now itself. Clear? So based on this, we will take up the entry. Before we proceed for the entry, what is the first entry? Business merger account debit. You can use business purchase itself, nothing to worry. Clear? So ICA sums, they will be using business purchase only. Clear? At the end of the day, something has to be received. That entry only you are passing. Clear? So point number 1, business merger account debit to liquidator of vendor company. Second entry, you are getting assets, liabilities, reserves, and business merger or purchase you are reversing. Third entry, you are settling the liquidator account debit to whatever you are settling. Liquidator of vendor company account debit to whatever you are settling. We will take up a sum immediately. Okay, Ajay Limited and Gokul Limited, equity and liability. Equity they have given equity share capital, preference share capital, general reserve, P&L, non-current liability, current liability, assets also they have given. Okay, G Limited acquired the A Limited. So G Limited is a purchasing company, A Limited is a transferor company. So G Limited is a acquiring company, the purchasing company. The amalgamation is said to be in the nature of merger. Okay, generally how to find, sir? Sometimes they will give the question. There is one more, there will be hidden information to find it also. G Limited, G Limited issued 1,25,000 equity shares of 10 each to the equity shareholder A Limited. Clear? And 55,000 preference shares of 10 each to the preference shares. My question is, you are giving 1,25,000 equity shares to equity shareholder. This will be considered for PC. 55,000 equity shares of preference shares of 10 each, you are giving it for preference shareholders. This will also be considered for PC. Past journal entries in the books of what? G Limited, the purchasing company, and also what? Prepare balance sheet after amalgamation. Clear? Very basic question to understand the concept. Listen. What is the first journal entry? Business merger account debit to liquidator of vendor company. This here vendor company is called as what Limited? A Limited. Correct, Amma? So business merger account debit to liquidator of what company? A Limited. So step number 1, name of the transferor. Okay, A Limited. Name of the transferee, G Limited. Correct? Next, name of nature of amalgamation. Amalgamation and nature of merger. Then what method we have to apply? Pooling of interest method. What is pooling of interest method? All assets, liabilities, and reserves of selling company should be incorporated in the books of what? Transferee or purchasing company. At what values? Book value, but adjusted. But what are adjusted? Next, first entry, business merger account debit to liquidator of A Limited. With what we have to debit and credit with PC. How to find PC? What we pay to debenture holders and what we pay to equity shareholders and preference shareholders are considered for PC. Whatever you pay to debenture creditors, they are not considered for PC. Okay, so we will calculate PC here. Okay, so what are the things we are paying for equity shareholders? 1,25,000 shares into 10 each. Correct? So 12,50,000. Then preference shareholders 55,000 preference shares of rupees 10 each. So how much? 5,50,000. So 1250 plus 5,50,000 is how much? 18 lakhs. Therefore PC is how much? 18 lakhs. Clear? So first entry is what? 18 lakhs and 18 lakhs. Clear? Next, assets of what company? Selling company. Assets of what company? Selling company. Okay, Ajay Limited is selling company. What are all the assets we are having? PP, non-current investment, including cash and bank we have to bring. Clear? Inventories and datas. Everything you have to bring. Okay, bring it at what value, sir? Book value itself. So 6 lakh 4, 12, 10, 8. Clear? So listen, 6, 4, 12, 10, 8. Similarly, liabilities also we have to bring along with the reserves. What are all the liabilities we are having, sir? Creditors we are having. Long term, general reserve and P&L. Bring everything. General reserve alone we have to adjust it. Listen, okay, general reserve value is 5 lakh. Okay, remember 7, 10, 5. Okay, so 7, 10 and general reserve value is what? 5. P&L is 3. Okay, actually general reserve is how much, 5 lakhs. Clear? Sir, but you are telling something should be adjusted. Yes, something should be adjusted. What to be adjusted, I will tell you. Okay, so we are bringing all assets, we are bringing all liabilities, along with the reserves also we are bringing. Correct? Reserves, one reserve alone I am just adjusting. What is that? I will tell you. After getting all assets, liability and reserves, whether still it is business merger receivable, business is received, we have received it. So reverse it. Correct? So this is also fine. We have to just understand why this 2 lakhs instead of 5 lakhs. We have to write book value only. No, sir, 5 lakhs. But why we are writing only 2 lakhs? Now listen to me. Okay, what is the PC we are paying? 18 lakhs we are paying. Correct? How much we are paying? 18 lakhs paying. What is the type of amalgamation? Nature of amalgamation? Amalgamation is the nature of merger. AS14 sees amalgamation in the nature of merger as a separate individual transaction. It is treated as a non-event. Or non-event means AS14 sees, I don't see you people have the purchasing company and selling company as if you are together. What? Now itself. I'll see you people as if you are together from the very beginning itself. Means that fellow instead of that building, here they are doing the business. Same people only there. Correct? Therefore, I am paying this purchase consideration to myself. Correct? After these people come to this building and these people are paying to those people only. Correct? It means you are paying to yourself. So actually, how much is the paid up capital you are having? How much is the capital you are having? Right? What we pay to equity and preference should be considered. No. What is payable to equity and preference? Okay. Go to the balance sheet of selling company. Equity and preference 10 plus 5. Total, how much is the capital? 15 lakhs is the capital. Actually, to myself, how much is payable? 50 lakhs is payable. But how much we are paying? 80 lakhs we are paying. Actually, to me, I should pay how much only? 15 only I have to pay. But how much I am paying to myself? 80 lakhs I am paying. Means how much extra I am paying? 3 lakhs. Generally, what we think, what we pay more than what we have to pay is called as goodwill. You have to pay 15, but you are paying 18. Generally, it is called as goodwill. But here, accountancy sees something differently. You are there that time. Now you are coming here, you are settling to yourself. You are settling instead of 15, you are settling 18. You are paying to yourself more. Correct? You are paying yourself more. You yourself, you are giving more number of shares. You yourself, you are giving what? More number of shares to yourself. Correct? Then accountancy sees this extra 3 lakhs as bonus given to themselves. Bonus to equity shareholders means you are settling your shareholders by giving extra shares of 3 lakhs. Free of cost. Clear? Therefore, this 3 lakh will be seen as if my company is giving, as if the the company, the selling company is giving to their shareholders extra shares without any consideration, means which is treated as what? Bonus shares. For bonus, what is the journal entry? Reserves account debit. In fact, I can write it like the CRR account, securities premium account debit, free reserves account debit to equity share capital. Correct? Then what is affected? Reserves are affected. What reserve should be affected, sir? Correct? They are telling CRR, securities premium, leave it. You should affect what reserve? Revenue reserve. Here, revenue reserve is what? Correct? So generally it should be called as goodwill. Generally it should be called as what? Goodwill. Correct? But they are telling you are paying what? Bonus to your own shareholders. So reserve should be affected. What should be affected? Reserve should be affected. If it is goodwill, what you would have done? You would have debited. Correct? How much you would have debited? 3 lakh extra you paid. No, you would have debited goodwill. But they are telling it should not be called as goodwill because you are paying more to yourself. If you pay to yourself more, it is called as self-payment. Self-payment, self-goodwill will not be recorded. That's why it is treated as bonus. So reserve should be adjusted. Therefore, what I should write here? Reserve should be written. What is the name of the reserve we are having? General reserve. So general reserve, how much? 3 lakhs. But general reserve, how much we are incorporating? 5. Sir, here also we are crediting general reserve 5 lakh. Here also we are debiting general reserve 3 lakh. 2 times you have to show us, sir. Net we have to show. Net we have to show. So here 5 lakhs, here 3 lakhs. Net where higher amount we are having? Net credit side higher. How much higher? 2 lakhs. So instead of writing general reserve debit 3 lakh and 5 lakh, straightly AS14 says adjust and write reserves as how much itself? 2 lakh. That's why what is adjusted? Reserves are adjusted. Clear or not clear? So listen to me. Therefore, whenever, sir, how to do in exam very quickly, sir? I'll tell you a trick also now. Listen. What you do? You bring all the assets, liabilities, reserves, everything at what? Book value. Have the general reserve as a balancing figure. Okay? Reverse the business merger also. So total it, total the debit side, total the credit side, total the credit side. Difference will become what? General reserve. Clear or not clear? That's it. And third one, third journal entry. When you make the payment to the liquidator of A Limited, we have to settle. No, liquidator of A Limited account debit to equity share capital, we are settling 12 lakh 50, and preference share capital, we are settling what? 5 lakh 50. With this sum is completed. Clear? Very, very easy sum. Yo, very easy. Sir, out of 5 conditions, if all 5 conditions satisfied only, you are telling no, it is pooling of interest merger, you are telling then pooling of interest method, then bring all assets, liabilities, reserves at their book value, and reserves alone may just make small adjustments, sir. You are telling that. What if, sir, out of 5, one not satisfied? Okay, you are telling no, every asset should be brought. Out of 5, anything cannot be satisfied. Clear? It can be anything. So, for example, say 90% of the people are not coming. Then it is amalgamation in the nature of purchase. Sir, assets and liabilities we are bringing, sir. Everything we are bringing, but not at book value. We are changing the value, revalued amount or agreed value. Some other number we are incorporating, sir. Then it is amalgamation in nature of purchase. Sir, all assets we are not bringing, sir. Okay, all assets we are not bringing. We are bringing all assets except cash, bank, patent, trademark. Except the word except, if you see, the moment you see except, then it is not called as amalgamation in the nature of merger. Then it is called as amalgamation in the nature of purchase. Because for amalgamation in the nature of merger, first condition itself, all assets you have to bring, including cash and bank, including cash and bank. Correct, sir? I will bring out of 10 assets, I will bring 10 on 10, sir. At book value, then merger. Okay, check for other conditions also for merger. Correct, sir? I am bringing all assets but not at book value, sir, some other value. Then it is merger. No need to follow pooling of interest method. Follow what method? Purchase method. Follow what method? Purchase method. Clear, sir? For purchase method, what are you saying? All the 5 satisfied? Merger. One also not satisfied. It is called as what? Purchase. Clear up? Merger, you understood something. Correct? Now let me teach you purchase also. After teaching purchase, I'll teach you the adjustment parts. Quickly we'll run through. Okay, short span we have to score high marks. Clear? Clarity. Okay, clarity, consistency, understanding and practice, coverage, everything is very, very important. I want you people to score highest marks. When amalgamation comes, just make sure you're smashing it off. Clear? Next, listen. Okay, sir, after this we have to prepare what also? Balance sheet also, no? Yes, sir, correct. Our company and the, okay, already we are having equity share capital and what? Preference share capital 70 and 20, the purchasing company. Now we have issued what? 1250 and 550. Add it and bring it to the outside column. General reserve, already we are having how much? 10 lakh and 5. Now after adjusting the general reserve, how much we are bringing it? 2 lakh. Correct? P&L of that company, how much we have brought? 3 lakh. So everything just added, because we are also existing company. We are bringing, like, one existing company is taking over other existing company. No, it is called as absorption. See, for absorption also what we are doing, same accounting only we are going to do. Amalgamation, external reconstruction, everything we are going to do. Clear or not clear? So our value and their company's assets, liability, resource, just add it and get the values accordingly. Clear? So total should be 150 lakhs. Total should be what? 150 lakhs. Just line by line item, as how you do for consolidations. Okay, like what you'll do, 6 plus 50, 56, 4 plus 50, 19, like that. You add everything from the balance sheet, you will get the answers accordingly. This is amalgamation in the nature of merger, starting 3 journal entries. What is the journal entry? What is the journal entries for amalgamation in nature of purchase, sir? First, when we will apply nature of purchase, if file 1 is also not satisfied, 2 not satisfied, 3 not satisfied, all the 5 not satisfied, but amalgamation only, sir, then we will apply what? Amalgamation in the nature of purchase. Amalgamation in the nature of purchase, how to account, sir? What method we have to do? The amalgamation in the nature of purchase method also purchase method. Amalgamation nature of purchase method also purchase method. In purchase method, what we will do is, not all assets and liabilities will bring. Whatever is taken over, that will bring. Not at book value, at agreed value. But sometimes what they will say, business itself we have what? Acquired. Business itself we have acquired. For some assets they will give agreed value. For some assets they will not tell anything. But they will say business itself is acquired. Clear? When they say the word business is acquired, all the assets they are bringing up. Some assets they will take it at agreed value. Some assets they will tell only business is brought, like, acquired, but they'll not give at what value we have actually got it. If question is silent, question said business is brought, clear, means all assets we are bringing in. And for some assets only they are giving agreed value, sir. For other assets they are not giving what? Agreed value. Then what we have to do, sir? Then what we have to do is, if in the question they said all assets are brought, okay, or business is brought, and they are telling for business brought, sir, in the business 10 assets are there. For 10 assets, for 4 assets they have given agreed value, but 6 assets they did not give agreed value. What we will do, sir? Then what you have to do is, book value is assumed to be agreed value. Clear? Point number 1, we are going to learn what? Amalgamation in the nature of purchase. What method? Purchase method. In purchase method, what are the things you can remember is, all assets and liabilities need not be incorporated. Clear? Whatever assets you are taking, whatever liabilities you are taking, that only you should incorporate that to at agreed value. Okay, question they have mentioned, we have, like, acquired that asset liability, sir, they did not give agreed value. Then book value is assumed to be agreed value. Most important point, the reserves of that company will not become our reserves, because the equity shareholders may become our equity shareholders, or they may go out of the business itself. That's why this is what is this is what actually we'll call it as amalgamation. This is what we actually called as acquisition. This is how we think as a purchase should be there. Correct? So this particular amalgamation in the amalgamation in the nature of purchase is treated as actual business acquisition. This is where we treat as if we are getting an outsider. We will pay more or less. That's why goodwill or capital reserve will appear in this, because they need not be our shareholders. They may even go. They will take their reserves and they'll go. For that we have to settle. Clear? Because their assets we are getting now. For that we have to settle them. Clear? Point number 1. What is the first journal entry you have to pass? Business purchase account debit to liquidator of vendor company. Clear? Purchase method means I'm using same only PC and PC. Here all assets today write or assets taken over I have written. Only assets taken over. Sir, whatever assets taken over, what value, sir? Only at the agreed value. Sir, they said asset taken over, value they did not say. What I should do, sir? Then you have to assume book value as what value? Agreed value. Clear? Liabilities also at what value? Agreed value. Sir, they said liability taken over, they did not say what value, sir? Then book value is assumed to be agreed value. So assets taken over, liabilities taken over, and you're agreeing to pay this much PC. If you pay more than the net assets acquired, the more is called as goodwill. If you pay less than the net assets acquired, that less is called as what? Capital reserve. That is called as what reserve, ma? Capital reserve. Clear? So this is actually called as what? Actual business acquisition, as if you are purchasing an outsider. Merger only accountancy treats as what? You are purchasing yourself. Correct? That's why goodwill or capital reserve will not be raised. It will be treated as bonus given to your own shareholders. Clear? Treated like that. Clear? And third entry is what? Same entry. Liquidator of vendor company account debit to. Here PC, whatever you pay to equity shareholders, no, you can pay whatever you want to pay to equity shareholders. For equity shareholders, not only equity shares. For purchase method, you can issue everything. But for merger method, for equity shareholders, we will issue only what? Equity shares only. Correct? Fractional shares, we will give what? Cash. One thing is, reserves are not brought. Seller company reserves are not brought because he is going, no. That's why it is called as purchase. Correct? So, reserves will not be incorporated in our books. But if there is any statutory reserve, as per the law, they have to maintain some reserve. They are maintaining one statutory reserve. But due to amalgamation, that company is liquidated. We are continuing that, or we may not continue. That reserves, what accountancy says is, array, that reserve is a statutory reserve. When you are acquiring that company, that reserve, for the namesake, you also show it as a statutory reserve only for some period. For example, statutory reserve has to be maintained for 5 years. They already maintained 2 years. 3 more years is pending. By that time you purchased. Accountancy says 40. Comply with the law. Balance 3 more years is there. No, incorporate as your statutory reserve. Sir, but statutory reserve should be credited. No, sir, to statutory reserve. But what I have to write in debit, sir? Because it is not my reserve. It should not affect my P&L or free reserves. No, accountancy says correct only. Yeah, I'm just asking you only for compliances. Correct? Then what I have to do? AAR. What is that? That is AAR. What is that? Amalgamation Adjustment Reserve. This is a temporary reserve which is created for the purpose of AS14, nothing other than that. Clear? Amalgamation Adjustment Reserve account debit to statutory reserve. For the next 3 years, you have to show this in your balance sheet. How we have to show, sir? In reserves and surplus itself, you show statutory. For example, 5 lakhs is there. Show the statutory reserve. This also should be shown as what? Amalgamation Adjustment Reserve. How much? 5 lakhs. But as a negative, you show in outside column, show it as what? Nil. Correct? Because it is not our reserve, but only for disclosure purpose, for compliance purpose you are doing it. After 3 years you can reverse this entry and you can nullify the entry. Clear or not clear? And after this balance sheet, it will not appear after the 3 years period. Clear? So this alone we have to reserve. This alone we have to remember. So point number 1, when it comes to merger only, we have to bring all the reserves and adjust one of the reserve for goodwill. That goodwill we will not say, if you pay more than what paid up capital, that should be adjusted. Clear? Clear? Listen. When it comes to merger only, all the reserves you are bringing at book value and small adjustments should be made. When it comes to amalgamation in nature of purchase, we should not bring reserves. We should not bring the reserves of what company? Selling company. Only one thing we have to maintain, only the statutory reserve. Other than statutory reserve, we will not maintain any other reserve. Clear? Okay or not okay? In which method we will get goodwill or capital reserve? Amalgamation in nature of purchase only will get what? Goodwill or capital reserve. But when it comes to amalgamation in nature of merger, goodwill or capital reserve will not arise. Everything will be adjusted in the reserves itself. If you pay more than the paid up capital, you have subtracted the reserve in the credit, correct, journal, correct. Sir, if I pay less, sir, 15 lakhs, sir, I myself paid only 11 lakhs, 4 lakhs for us profit, sir, correct. Then increase the reserves, increase. So when you pay more than the paid up capital, in case of amalgamation in the nature of merger, when it comes to amalgamation in the nature of merger, if you pay more, subtract from the reserve. Sir, capital is 15 lakhs, that is added. Not they are telling 11 lakhs, you have to pay 15 lakhs, you are paying only 11 lakhs, therefore they are telling 4 lakhs, add it to the reserves, and increase the reserves. Clear or not clear? Hello. So that is what they are telling for merger. But when it comes to purchase, goodwill or capital reserve will arise. What will arise, Ra? Goodwill or capital reserve will arise. Clear? Okay, what are the three entries, Ra? First here is business purchase account debit to what account? Liquidator of vendor company. Assets, next is assets taken over, liability taken over, reserves taken over, not taken over, are not taken over. What taken over? Reserves not taken over, but only statutory reserves is maintained. Okay, so for that PC, if you are paying more, goodwill will arise. This is called as purchased goodwill. No, sir, I am paying less, sir. Capital profit, take it to what reserve? Capital reserve. When you settle the liquidator, pass this entry. Statutory reserves you have to maintain. If this is when question requires only, you will do. So every time you will get 4 entries or no, 3 entries mandatory, 4th entry depends upon the question. Shall we do one sum here? Listen to me. P Limited acquired the business of S Limited, okay, whose balance sheet as on 31st March 2025 is as follows. S Limited's balance sheet they have given, okay ba? So P Limited is purchasing company, is acquiring the business of S Limited. This is a selling company. So P Limited, array sir, but when they give S Limited balance sheet, when they are giving S Limited selling company balance sheet, they are giving, sir. What about purchasing company balance sheet? They did not give. No, sir. It is assumed that purchasing company, this company is a new company. This company is what company? A new company is taking over a existing company. This is called as external reconstruction. This is called as what, ma? External reconstruction. Correct? Whether it is external reconstruction, absorption, or what, amalgamation, accounting is same. Accounting is what? Same. Only difference is when you are doing the balance sheet, okay, after amalgamation, for the purchasing company, everything will be 0. Just you have to add only the selling company's value for the balance sheet after what? Amalgamation. Clear? Point number 1, S Limited balance sheet. What are the things they have given in S Limited balance sheet is equity share capital, preference share capital, reserves they have given, okay, workman compensation reserve, liabilities they have given, total they have given, okay. Such side they have given everything. Already there is an existing goodwill, inventories, debtors and cash and bank. Listen, P Limited was to take over all the assets except, the word except, if you see, no, whether they are bringing all the assets or they are leaving cash and bank as well as all liabilities they are bringing except reserves and outstanding expense. The moment you see they are not taking over reserves or one or few assets or liability, they are not taking over, then it is called as amalgamation in the nature of what, ma? Purchase. Because amalgamation in nature of merger means they have to bring all assets, liabilities and reserves also. Here they are leaving one asset, here they are leaving one liability, here they are leaving the reserves. That's why it is called as nature of what? Purchase. Then what method we have to adopt? Purchase method. What is purchase method? All assets, liability, whatever is taken over only should be brought and incorporated in our books. That too at what value? Book value or agreed value? Agreed value. Clear? Yes or no? So for this they have agreed to pay the following amounts. For each equity shares of selling company S Limited, 20 rupees is paid in cash, and also they are giving cash for equity shareholders. Also they are giving one equity share of purchasing company. We are purchasing company, are telling, array, you people are there, no, for you I'll give you cash also, and also for equity shareholders I'll give you one equity shares, 1:1 ratio. Clear? How many equity shareholders are there? If 8 lakh rupees, 100 rupees each means how many shares, ma? 8,000 shares. Similarly, 4 lakh rupees is the preference share capital. 100 each means how many preference? 4,000. So there are 8,000. Just imagine 8,000 equity shareholders are there. 4,000 preference shareholders are there in the selling company. First we are calling equity shareholders. Equity shareholders come. 8,000 people are coming. Clear? Just imagine, just for understanding. 8,000 people. Array, like you know, equity shareholders for you. For each of you, I'll give you 20, 20, 20. Along with that, one share of my company, I'll give you. Clear? Like this we are telling. So for PC, equity shareholders you are paying what? Cash also you are giving. Equity share also you are giving. For preference share also you called. Okay, you people go. Then preference shareholders you come. Clear? How many people are giving? 4,000 people. Just imagine. Okay, 4,000. I am telling, for you people I'll give you, for everyone 10 rupees I'll give you. Along with it I'll also give you what? Preference shares of my company also I'll give you. So preference shareholders also they are giving. Clear? P Limited valued. Okay, well, our company is valuing the land, building, plant and machinery and trademarks and patents at respective value. I told you, know, whatever assets they are taking in the case of purchase, it should be at agreed value. It should be at what value? Agreed value. Sir, but they said no, they have got all the assets, but information is given only for land and building, plant and machinery, trademark and patent. Correct? So land and building, plant and machinery, trademark and patent only they have given agreed value, no sir, then we will take that value only. What about other assets are what we have to do? Then accountant says, they said they did not take over only water, they did not take over only cash, but they have taken this, no sir, what I have to do, what is the value I have to do? They are telling, array, here agreed value is assumed to be what only? Book value only. So when I pass the entry, second entry, I have to take everything at what value? Book, that is agreed value. Here I have to take the book value that is assumed to be agreed value. Clarity you are having a point number one. Sorry sir, what is the PC calculation? PC means what? Whatever you pay to equity and preference shareholders, that is called as what? Purchase consideration. That is called as what consideration, ma? Purchase consideration. So let's calculate purchase consideration. Okay, wow. So first, as usual, okay, all Sastra Sampradayam, everything will write. Name of the transferor, transferee, okay, nature what? Amalgamation nature of purchase, and method is amalgamation nature of what? Purchase means purchase method we have to use. Calculation of what? PC. Clear? So PC means payment made to equity and preference. What you make to debenture holders will be form part of PCA, will not form part of PCA, will not form part of PC. Point number one. How many equity shareholders? 8,000. For each of them 20 I am giving. Along with the 20 I am giving my purchasing company share, each share at what? 140. Clear? So 8,000 into 20 cash, 8,000 into 140 in equity shares. So 1 lakh 60, 11 lakh 20. For equity shareholders, how much I am giving? 12 lakh 80,000. This I would have written for what? Passing the journal entry. 1 for 100 rupees for I am giving it 140. So 100 is face value, premium is 40. Clear? So 8,000 into 100, 8 lakh is the equity share capital value. Premium value is how much? 3 lakh 20,000. Clear? So put together only I am calling it as 11 lakh 20. So total how much I paid to 160 and 120. Total how much I pay to equity shareholders? 12 lakh 80,000. Same like this, there are 4,000 preference shareholders. Cash 10 rupees I am giving. Preference shareholders I am settling with my equity, my preference shares. For each preference share, one preference shares of our company of 100 is issued at what only? Par only. So 100 means 100 only I am giving. 4,000 into 100. So 4,000 into 10, 40. 4,000 into 100, 4 lakhs. Okay. So put together 440. So total for preference shareholders I am paying 440. For equity shareholders I am paying amount of how much? 12 lakh 80,000. Put together I am paying how much? 17 lakh 20,000 is the PC that I have to decide. Therefore the first journal entry in case of amalgamation in the nature of purchase. What is the first journal entry? Business purchase second debit to liquidator of S Limited at what value? PC. Second journal entry, remember, all assets taken over, liabilities taken over. Only the taken over, because we are in the nature of purchase. 200 times also I am ready to tell. Your thing is remember that alone. Okay. Whatever you are listening now, right, when you are seeing the class itself, this notes will be available in KS Academy Telegram channel. Download it, take print out, write whatever I am telling. After listening to the class, please you also do one time, because listening is one way, practice is one more way. Clear up? When you practice only you will get the momentum of doing the sum. Clear up? So point number one, as I said, land, building, plant and machinery, trademarks and patents at what value? Agreed value. What about that inventories? Okay, sundry debtors and goodwill, it should be taken at what? At what value? Book value, because that is assumed to be agreed value. Clear? So as 150, 180, 175, because those numbers are only there. No, come on, 150, 175, 180. Where is that? Okay, 175, 150, 180. Clear? So same values I am taking, 175, 180 and everything I am taking. Correct? Sir, but we have to find, no, goodwill is already there, that you are taking up. Listen, first listen, then you do what I am telling you to do in exam. Liabilities also. Okay, ma, what are all the liabilities we are having, ma? Okay, they are telling, no, all liabilities are taken except reserves and outstanding expense. So outstanding expense they did not take, and reserves they are not taking up. Apart from this, they are taking these two liabilities. Correct? So we'll read the question fully. Workman compensation claim was how much? 5,000. So there is a reserve. Leave the reserve, but there is a claim. No, claim is a amount which we have to pay. It's a liability. So this liability we have to consider for second journal entry. Similarly, debenture holders, whichever we are taking up, 2 lakh we should not take. They are giving the value at which we are going to settle, agreed value, which we have to consider for second journal entry. 6% debentures of S Limited to be issued. How much, ma? 8% debentures of 100 each in P Limited. For this purpose, each debenture of S Limited is treated as how much? 110. First, let me see how many debentures are there. 2 lakh. They are telling each debenture is 100. Correct? Therefore, how many debentures will be there? 2,000 debentures. Actually, if nothing is given in the question, Correct. If nothing is given in the question, as they said all the liabilities are taken, I would have taken the debentures also at what value? 2 lakh itself I would have taken. But they are telling all assets are taken. No, whatever is the taken amount, we have to, whatever is the liabilities taken over, it should be at what value? Agreed value. If question is silent, I would have taken what? 2000 into 100, 2 lakh. But they are telling for the purpose, the agreed value of settlement is what? 110. That's why 2000 into 110. How much I have taken? 2,20,000. How much I have taken? 2,20,000. Clear? That is the agreed value. Creditors at the book value only you have to take. Workman compensation reserve you should not consider. Correct? But what you can take is workman compensation claim they have given in the adjustment number 4. No, that you have to consider. How much? NTA 20 only 5,000. Only 5,000. After getting assets taken over, liability taken over, still any business is to be received or received? Received. So that also I am reversing. Correct? When you sum up, the credit total comes to how much? 20,65,000. Debit total up to goodwill comes to how much? This value. Correct. The difference will be in the debit side. How much is the debit side difference? Is 340. Means we are paying more, which is called as what? Goodwill. Which is called as what? Goodwill. Clear or not clear? For this net assets, you are settling how much? 17,20,000. Means you are paying more. Difference in the debit side means you are settling more goodwill. So 340. Sir, already there is a goodwill. No, here also you are having one goodwill. No, sir. 2 times you have to show, one time. So in exam what you have to do is, whenever you are having goodwill, no, just write in somewhere in pencil or something. Clear? After that, take the debits, subtract the liabilities, you will get the net assets. From net assets, if you compare the PC, okay, you would have paid, in the sum you would have paid more. How much more you would have paid is 340 you would have paid. Clear? So 340. So along with that 175, 340 add, put together you show it as what? Goodwill. Put together you show it as what? Goodwill. Clear or not clear? Okay or not okay? Sir, what if the case if I am getting capital reserve? Sir, write capital reserve. Lastly, what you have to do? You have to write off the goodwill with the capital reserve. Only one should appear in the balance sheet, either goodwill or capital reserve. Sometimes we will take over 2 companies. Okay, for one company you will get goodwill, for another company you will get capital reserve. Assume one company you got 3,40,000 as goodwill, another company you got capital reserve 5 lakh. Sir, in balance sheet we have to show goodwill 340 and capital reserve 5 lakhs. Sir, no, net off and show whoever is high. Okay, well, in our example capital reserve would be high. Show capital reserve. Okay, pass the net entry. Write off the goodwill using the capital reserve. Sir, one company goodwill, sir, another company capital reserve 1 lakh. Goodwill is high, sir. So write off and show the net goodwill as how much? 2,40,000. Clear or not clear? So only one you have to show, not everything. Clear? Hello. So point number 1, first entry is business purchase account debit to liquidator of S Limited. How much? Rare? Tell rare. Focus. Don't see anything. Just focus. Don't do anything. Put to your mobile. So stop eating. See here. 17,20,000. 17,20,000. Correct? So after this, I am passing this entry. Goodwill we have got this sum. So what happens? Last entry is liquidator of S Limited account to whom we have to pay equity share capital, preference capital, and along with that we are paying. What are the things we are settling? Come on, cash we are settling. Cash total 160 plus 40. 160 plus 40 comes to how much? 2 lakhs. So bank balance 2. Equity share capital we are having premium also for the purpose of journal entry only. I have calculated separately. This 11,20,000 I have calculated separately. Equity share capital face value, premium value. So 8 lakh and 320. Clear? Preference comes to 4 lakh. Clear? So when you see the entry, equity share capital 8 lakh and premium 320, preference capital 4 lakh, and total cash comes to how much now? 160 plus 40, 2 lakhs. With this is completed. And for the debenture holders, we are giving them what are new shares. Old is cancelled, new is given. So 6% debentures should be cancelled. So reverse it. New should be given 8%. At what value? 2,20,000 is what you are agreeing. No, that value you have to do. Clear? So with this general understanding of merger and purchase, you have understood. Correct? Now let me teach you what adjustments. Ready? Adjustments? Okay. Point number 1. What are all the adjustments we are having, sir? See what happens. See, like we will have mutual company owings. I would have sold to him, he would have purchased from me, or I would have purchased from him, he would have sold to me. Correct? So at the time of passing second journal entry, listen, one point I'll tell you quickly. Remember, when you are passing, whenever you are, see for example, we are what? Purchasing company. They are selling company. One example I'll tell you. Clear? Assume we are having sundry debtors 1 lakh we are having. Here they will have what? Sundry creditors 1 lakh. Clear? So what happens? Okay, when I'm incorporating, I'll incorporate in the second journal entry, I'll incorporate what are sundry creditors, 2 sundry creditors, 1 lakh, I'll write. Clear? But after bringing it, when you prepare the balance sheet after amalgamation, already we are having how much? Sundry debtor of 1 lakh, which is what? Which is receivable from selling company. Okay. Now there that creditors also I pass the journal entry, in the second journal entry I have credited, correct? Then this will also appear in the balance sheet as what? Sundry creditors, correct? Sundry creditors of what company? Purchasing company 1 lakh, correct? After amalgamation, you just think of a situation, no? I have incorporated everything. After incorporating in the same balance sheet, I myself I am showing debtor 1 lakh and creditor 1 lakh. Now my question is, after amalgamation we are same, no? How can I say I have to receive from myself? How can I say I have to pay to myself? Yes or no? How can I say how can I say how I have to receive from myself? How can I say I have to pay to myself? Correct or not correct? Not correct. Therefore, I cannot pay to myself. I cannot receive from myself. Therefore, it should be eliminated. How to eliminate this, sir? They are telling creditors you have to eliminate. So debit creditors, debtors you have to eliminate. So debit debtors. So sundry debtors account debit, creditors account debit to sundry debtors account. Clear, ama? So for elimination of what? Intercompany owings, what we have to pass? Sundry creditors account debit to sundry debtors account. Clear? Same as the journal entry. Sir, whether we are we have to pay, they have to pay. Okay, it can be anything. Okay, va? Either we can show them as debtor or we can show them as creditor. They can show us as debtor or they can show us as creditor. Only one entry. Whoever's balance sheet it is showing as creditor, that creditor should be reversed. Whoever's balance sheet is showing as what? Sundry debtors, that should be reversed. Okay, but this elimination should be done after passing second journal entry, third journal entry, fourth journal. After that only have to eliminate. While passing second entry itself, you should not eliminate. Bring first full whatever amount you are agreeing to bring. Then see, without passing second journal entry, how can you say that it is there? Correct? If you pass this entry only, it will be there. Then only you can eliminate. Without passing this entry, whether this fellow will appear or will not appear, will not appear. If not, if you are not passing this entry and if you are not passing this entry, he will not appear. Without showing this, can you eliminate or cannot eliminate? You cannot eliminate. Correct? Therefore, always remember this point alone 200 times. I will tell. Listen to me. Okay. This elimination should happen after passing second entry, third entry. Before that, you should not, because based on this creditor, based on this subtraction from assets, then after finding net assets, on the basis of this only PC will be considered. Correct? So first cross 3 journal entries, then you have to eliminate. Before that, you should never eliminate. Because after passing only, then they will be there. Then only they will see each other's faces. Then we have to eliminate. Without bringing it, how can you say these people are facing each other? No. So they are telling first to pass the second entry, third entry you pass, then you do the elimination. Don't do the elimination before second entry itself. After 3 entries only you have to think about elimination. Therefore, to eliminate intercompany owings, to eliminate what are intercompany owings, whatever adjustment I am teaching, it is common for both the methods, merger as well as what? Purchase method. Clear? So the journal entries, come on, what is that? The journal entries, like, what is that? Creditors account debit to debtors account, trade payables account debit to trade receivables. It can be any companies, trade payables or trade receivables. Clear? Point number 1. Sir, what if amounts are not same? Sir, what if amounts are not same? For example, you are telling here we are having 1 lakh, here we are having what? 1 lakh. If this is a story, this is fine, sir. But the story is like this, sir. Okay, creditors we are having only 70,000, but here we are having 1 lakh, sir. How it is possible? Entire creditors is what? Selling company, here purchasing company, no other outsiders there. If same amount is there, no, we can write 1 lakh and 1 lakh. If different amount is there, what we have to do is accountancy sees. Okay, if there is a difference, it is treated as what? Cash in cash in transit. What in transit? Cash in transit. That is, these people have already paid to the creditors. They have passed what entry? Cash or back. That is, they have passed that cash in transit. That is, how we have to think is, if the amounts are not same, it means someone has sent some other person the amount. For example, here the amount is less, no, correct? It means he has paid the amount to the creditor. So sundry creditors account debit to, he has paid the amount, correct? That's why 30,000 it is decreased. He has decreased the amount. Really has decreased. That's why from 1 lakh 30 subtracted 70 is visible. For him it is not, it is yet to be received. It is what to be received. A check I would have given, it will take some time, correct? So it will be in the processing time. So he would have not passed the entry. Then what we have to do is, he has done his part, we have to do that part. So cash in transit account debit to sundry debtors account we have to pass, correct? So how much is that? 30,000. After passing this entry, then in our books how much it will be? 70,000. Clear? Then you have to eliminate the 70,000 also. Clear or not clear? So in case of difference arises in the trade receivables, it should be actually same amount, right? It should be actually what amount? Same amount. Same amount in the sense our owing should be same amount, not sir, for example, sundry debtors we are having what? 10 lakhs. Okay, wow. Okay, here sundry creditors is what? Say 13 lakhs. This is same I am telling, or the mutual owing same I am telling, mutual owings. For example, selling company 5 lakhs means here also it should be purchasing company how much we have to pay? 1 lakh. It should be same. If it is same means what is the entry we have to pass? Sundry creditors account debit to sundry debtors account. How much we have to eliminate? Entire 10 lakh, 30 lakh eliminate. No, you have to eliminate only what? The mutual owings. Repeatedly mutual amount you have to do it. If this itself is not same means then we have to pass one entry, cash in transit entry or stock in transit entry. Clear or not clear? So I would have taught you this many times in the class. Okay, so whenever there is a difference, it is treated as what? Cash in transit. The entry will be what? Cash in transit account debit to trade receivables account. Clear? Sir, sometimes here we are showing more, sir. Okay, here it is more, sir. Okay, here these people did not send the money, sir, but still there is a 70,000. Here we are showing more amount. It means this fellow has sent goods. This fellow is yet to receive the stock. So that fellow has to pass what entry? Stock in transit account debit to trade payables account. He has to pass. Accordingly, after adjusting, bring it to same value. Then you have to eliminate. Clear? Elimination should happen in second entry after 3-4 entries. After 3 or 4th entry, you have to do it. Same is the case for what? Bills payable and bills receivable also. Mutual owing should be eliminated. Clear? Bills payable account debit to bills receivable, it can be anything. It is common for merger as well as what? Merger. Sir, what should not be eliminated? I will tell you, listen. Here also I will give you clarity. Listen, bills receivable we are having, okay? Here this fellow, the selling company, is having bills payable. Okay, here we are showing what? Here he is showing 2 lakhs. Here we are showing only 1,50,000. Sir, entire amount is from selling company. This is entirely payable to purchasing company only. Correct? Sir, amount if it is same means what entry will pass? Bills payable to bills receivable 2 lakh we done. But amount is not same. No, sir. What is the story, sir? Then it means actually here itself it should be 2 lakhs only. It should be how much? 2 lakh. But out of 2 lakh, what happened is 50,000 we would have endorsed to some other person. An outsider we would have given, correct? Or we would have discounted with the bank, correct? So it is actually payable to bank. Therefore, even though bills receivable is 2 lakh, 50,000 I have given to some other person. No, therefore between you and me only how much is amount? 1,50,000. The 50,000 is between us. It is between us and outsiders. It is with the outsider. Outsider amount should not be eliminated. What is between you both, purchasing company, selling company, that only is called as mutual owing. That should be eliminated, correct? So out of 2 lakh, how much is between us for the purchasing and selling company? 2 lakh? No, it is 150 only. So when I pass the entry, bills payable account debit to bills receivable account, entire 2 lakh should not be eliminated. I should eliminate only how much? 1,50,000, 1,50,000. 2 lakh will be shown as what? Bills payable after amalgamation. That is in the 2 lakh 150 gone. 50,000 is shown as what? Bills payable to the outsider. Outsider, it is not mutual owing. Outsider, he will speak superly, correct? If you don't show that 50,000, no, we are not showing the reality in the books of accounts. Reality is 50,000 is payable to outsider. That should be there, correct? Therefore, you should not eliminate 2 lakh. You have to eliminate only mutual owing of 150 and 150. Therefore, after amalgamation, what will be there is in balance sheet, who will not appear? Bills receivable will not be there because entire 150 got. Bills payable also 2 lakh will not be there. It will be only 50,000. Clear? Because this is the actual liability which we have to pay to the outsider, which is not mutual between us. Clear? So that alone we have to eliminate. That alone we have to eliminate, not everything. Clear? So we have to eliminate all the bills receivable, all the bills payable which are common or mutual between us, not entire amount whichever is payable to outsider, correct? Only mutual owing should be eliminated, not everything, correct? Therefore, you have to eliminate what? Bills receivable, bills payable, except what? Bills discounted, endorsed, and which is payable or receivable to the outsider. That should be there. Mutual owing should be eliminated, not everything. Clear? Similarly, one person would have given loan, one person would have taken loan, correct? So after see every adjustment, okay, mutual owings, elimination, bills, that is debtor, creditor, bills receivable, bills payable, loans, everything should not be adjusted before second entry. For the second entry, bring that liability also, bring that asset also. Based on that only PC will be calculated. After that only, after passing that only, that person's asset will be there, our liability will be, then only you can cancel. Without bringing it, how can you cancel it? So first bring that asset or liability, that debtor, creditor, bills receivable, bills payable of some other company, the selling company, first bring it in the second entry. Then you should eliminate. Repeatedly I am telling you, okay, first bring. Don't eliminate before the third entry. Clear? After third entry or fourth entry in case of any statutory reserve, after that only you have to eliminate. Before that you should never eliminate, kana. Please remember this. Okay, so these entries we have to pass after the PC entries and all, after payment entry. So one person would have bought the loan and other person would have given. Okay, so what would have happened? I would have brought that loan, correct, and here I would have advanced his liability. I'm bringing in second January. Now after bringing in, after passing the entry, it will be in the same balance sheet. No, I cannot receive from myself, I cannot pay to myself. That's why it is eliminated by passing this entry. Liability account should be reversed, assets should be reversed. So liabilities will have credit balance, to reverse I am debiting. Assets will have debit balance, to reverse I am crediting. So by eliminating, what will happen? We will show something that is outside to outsider. How much is the amount we have to pay? How much is the amount we have to receive from the outsider? Clear? Similarly for unrealized stock also, we would have sold some goods to, for example, assume we are selling goods to our selling company. At profit we would have sold. Okay, out of goods sold, see 10,000. Okay, we are selling at a profit of 5, so totally 15,000 we are selling. Entire 15,000 is unsold, so it will be in the closing stock of which company? Selling company, 15,000. Correct? What we will do at the time of passing second January, this also will bring in, correct? When you bring in, what you will do? Inventories will be debited. That inventories will be shown in our books. No, correct? Inventories, it will be appearing at 15. But now my question is, when we sold, our cost was how much? 10. Same goods, can I show it as 15 now? No, because inventory should be valued at cost or NRV, whichever is low. But this 15 after amalgamation, for me, it is called as cost, it is called as selling price or selling price. That 5,000 I should eliminate. Correct? How to eliminate the inventory? Inventory value should be decreased by 5,000. No, so inventory to decrease I will credit. So stock should be credited. What is the corresponding debit, sir? If it is merger, debit the reserves. If it is purchase, in purchase, in second entry, if you get goodwill, debit goodwill. If you get capital reserve, debit capital reserve. Clear or not clear? Agana? So simple gada. So inventories, unrealized profit, decrease the stock value. Decrease the stock value. Corresponding debit depends upon the merger or purchase. If it is merger, reserves. If it is purchase, means what? Goodwill or capital reserve. Sir, this word, this you did not tell in what? First three. No, first three we did not say, because assets and liabilities are changing. Okay. So what we have to do? Here payables to receivable. Here also payables to receivable. Here also what? Payables to receivable, whether it is nature of merger or purchase. Clear? Okay, except bills discounted and bills endorsed, that should not be eliminated because it is outside. Here also same entry for merger and purchase. Here only the corresponding debit should be reserve or goodwill or capital reserve. If in the second entry you got goodwill, means debit goodwill. If in the second entry, if you got capital reserve, means debit capital reserve. Clear, ama? Sir, goods are sold at loss. No need to worry, leave it, no adjustment is required. Liquidation expenses, sir. Sir, actually that fellow is liquidating, sir. Okay, he has to pay the expense, but we are telling we will pay that on behalf of seller. We are promising him to pay it. Correct? So what is the journal entry? Expenses paid means what is the entry? Expense account debit to bank account. Correct? Here name of the expense is what? Liquidation expense. So first I will teach you for merger. Clear? What is the journal entry for liquidation expenses? Liquidation expense account debit to bank account. Liquidation expense account debit to bank. Being a nominal account, we have to close. Correct? But in merger, we are going closing and taking it to reserve. So reserves account debit to liquidation expense account. Reserves account debit to what account? Liquidation expense account. Therefore, the net entry is what? Reserves account debit to bank account. Reserves account debit to bank account. If it is amalgamation in nature of purchase, same entry, but instead of reserves, we are going to use what? Goodwill or capital reserve. So goodwill or capital reserve account debit to liquidation expense account. Therefore, the entry will be what? Goodwill or capital reserve account debit to bank account. In exam straightly you can pass this entry also. Clear? Sir, liquidation expenses 10,000. Sir, listen to me. Liquidation expenses 10,000. I am telling for this. Clear? Liquidation expenses 10,000, sir. And the second journal entry, whatever we passed, there we are having goodwill of say 15,000. Okay, then now we are paying. See, second entry already you are having goodwill of 15,000. Now you are paying liquidation expenses of selling company on their behalf. You are doing it. Clear? Yes or no? Now what is the journal entry you have to pass, sir? They are telling in second entry goodwill. Now for now liquidation expense also you have to pass what entry? Goodwill account debit to bank account. Goodwill account debit to bank account 10,000 and 10,000. Therefore total goodwill which we have to show in the balance sheet becomes what? 15 from second journal entry, 10 from this. Total goodwill is how much? Total goodwill is 25,000 we have to show. How much goodwill we have to show? 25. Why, sir? Already you are paying more. Now even after paying more, once again that expense you are paying on his behalf, means that also you are paying. Why you have to pay for him? He should pay, no? For that you are paying. Now accountancy, this also you are paying for the brand value only. It is included or merged with goodwill itself, correct? Already you paid more. Once again you are giving more, correct? That also goodwill, this also goodwill. Total goodwill comes to how much? 25,000. Total goodwill comes to 25,000, sir. Second entry, we got capital reserve, sir. Capital reserve 28,000 I got. Now I got what? Liquidation expense. Correct? What entry I have to pass, sir? What entry I have to pass is accountancy says, oh, already you are enjoying a capital profit of 28,000. You paid them less. They are crying. They are begging you. At least pay liquidation expense. Already you are paying 28,000 less. Now I don't have money to pay liquidation. You take care. Like that they are asking. Okay. Now accountancy says, okay, at the time of acquisition, you are enjoying a capital profit of 28,000. Correct? Now accountancy says, this liquidation expense, when you make the payment, don't feel very happy that in your pockets 28,000 is there. By accepting 28,000, okay, by paying less 28,000 you are having as a profit, but you are accepting what also? Liquidation expense also you are paying, correct? Now how much you are settling? 10,000 you are settling. Therefore after giving that 28,000 profit, but in the other hand you are giving away what? You are giving away for liquidation expense. Therefore in pockets you will have only how much? 18,000. Therefore your capital reserve at the end of the day, it should be 28,000 or 28,000 minus this liquidation expense of 10, balance 18,000 only. Balance 18,000 only. Therefore when I make the liquidation expense entry, what is the entry I'll pass? Capital reserve account debit to bank account. Repeat once again, ma. Capital reserve account debit to bank account 10,000 and 10,000. Clear? Sir, my capital reserve is there, sir. In second journal entry, my capital reserve is 6,000, sir. What I have to do is, okay, and liquidation expenses of selling company, I'm making the payments, sir, 10,000. Now what entry I have to pass, sir? What entry I have to pass, sir? Listen, accountancy says, oh, how much profit you are having? 6,000. But you are having profit, but why are you agreeing to pay more? Correct? You are agreeing to pay liquidation. That too not 6,000 you are paying 10,000. Correct? Means you are in one side you are happy 6,000 you are having profit, but in the other side you are going to sacrifice 10,000. Therefore sacrifice is more than the profit. How much is the more sacrifice? 4,000 is the more sacrifice. Correct? You are paying more. How much? 4,000. Therefore the entry should be capital reserve fully gone. Correct? Your actual outflow is how much? 10,000. Correct? But you are enjoying a profit. They are telling the profit is not there even after. In pocket 6,000 is there, but in other pockets you are giving how much? 10. In net how much you are gaining? You are losing. You are losing. You are paying more. So 10,000 you paid, 6,000 is the profit. Correct? So profit gone after sacrificing, after foregoing that profits, extra you are paying 4,000. That extra you are paying 4,000 is called as what? Goodwill. That's why the entry will be capital reserve or goodwill account debit to bank account in case of what? Amalgamation and nature of purchase when it comes to liquidation expense. Liquidation expenses of selling company paid by the selling company, what is the entry? They have to pass in their books. I will tell you in their books how to pass the entry. Clear? So amalgamation and nature of merger for the liquidation expenses of selling company paid by the purchasing company. What is the journal entry in the books of which company? In the books of purchasing company, if it is merger, the entry will be reserves account debit to bank account. If it is merger, means goodwill or capital reserve account debit to bank account. Clear? This is how we have to remember for goodwill or capital reserve liquidation expenses. Able to understand? Come on, Agada. So we will go with debentures. Okay, what happens is already we will be holding some debentures in what company? In the other company. Correct? So that mutual debentures also we have to eliminate. We have to eliminate. Merger I will teach you. So to eliminate the debentures held by the selling company in the purchasing company, they are holding in our company. Then what they are telling is, okay, so to eliminate selling company is holding, come on, to eliminate debentures held by selling company in the purchasing company. So in our company, okay, we are having debentures which is held by what? Like that selling company is having it as an investment. While you are passing the journal entry, investment you bring it. Clear? Then after passing second entry, third entry, what happens? After passing second entry, investment will appear. No, correct? Investment in what company? Purchasing company. We in selling company we have debentures. Correct? In our books we are having debentures that were already invested by what company? Purchasing company. So in the same balance sheet we will have what? In my own company I am having having my debentures as a liability and investment in debentures, which I have to cancel it. So what I have to do? Liability should be cancelled, debited. Asset should be what? Cancelled, credited. Clear? Whether you are, whether these people are investing in your debentures or you are investing in their debentures, same entry only. Clear? So that one asset and one liability should be ignored. So debentures of what company? In our company, purchasing companies. Okay, purchasing company debentures should be eliminated. Investment of selling company in purchasing company should be eliminated. Difference will be there, no? Correct? That should be taken to reserves. That should be taken to reserve. No sir, purchasing company is holding on what company? Selling company. So in our books we are having investments, sir. Okay, when we are incorporating the debentures, that company debentures also we have incorporated in second journal entry. After passing the first three entries, we are seeing, what sir, within the same company we are having debentures and investment also. Then they are telling, eliminate that also. Difference should be taken to reserves. Okay, in case of what? Merger. If it is purchase method, means the difference should be adjusted with goodwill or capital reserve. It should be adjusted in what? Goodwill or capital reserve. So these are the adjustments which you have to remember. Listen, once again I'll revise it. Okay, trade receivables, trade payables, common amounts are there. Then what we have to do? We have to eliminate by passing what? Trade payables account debit to trade receivables. It can be any company's trade receivables or trade payable. That entry you have to pass and we have to eliminate. Clear? Point number 2. Bills receivable, bills payable. Same entry you have to pass. What is the entry? Bills payable should be eliminated. 2 bills receivable should be eliminated. Correct? What should not be eliminated is what is with the outsider should not be eliminated. Within us, sir, bills receivable there, bills payable there. Correct? But what happened? That fellow has what? Endorsed or discounted with the bank. That should not be eliminated. What is not discounted, what is not eliminated should be, what is not discounted, what is not endorsed should not be eliminated. Okay, because that is outsider. Clear? That is, I'll repeat, what is discounted, what is endorsed, what is discounted to outsider, what is endorsed to the outsider, that should be what? Eliminated. Clear? Sorry, what is that? What is endorsed or what is discounted to the outsider, that should not be eliminated. What is not discounted with us, what is not endorsed, that is with us, that should be eliminated. Clear? Array, don't talk. See here. Clear? So that is how we have to do. Clear, Amma? Okay, so bills receivable, bills payable, that which is endorsed and which is discounted, that should not be eliminated. Which is not discounted, which is not endorsed, which is with us, that should be eliminated. Clear? Listen, able to understand? So trade receivables, trade, okay, receivables, debtors, creditors over, bills receivable, bills payable over, and also what are unrealized profit, you would have understood. Unrealized profit means stock should be credited, corresponding debit depends upon the method. Merger means reserve should be debited. Okay, purchase means what should be debited? Goodwill or capital reserve. Liquidation expenses also. If it is amalgamation in the nature of merger, reserves account debit to bank account. If amalgamation in the nature of purchase means goodwill or capital reserve account debit to what account? Bank account. Clear? Debentures also you should have understood. Clear? Sir, there is a difference between what, sir, receivables and payables, sir. Then you have to understand like what? Cash in transit or goods in transit, stock in transit. Same will be there in what also? In consolidation also. Same will be there in consolidation. Same I will be teaching that time also. Clear? Based on, sir, means what are you telling? 3 entries are there, sir. PC, if you find in all the 3 entries, PC will be there. Business purchase to what? Liquidator, PC only. Assets, liabilities, if it is merger means book values, reserves will be taken, book values. Correct? And difference should be adjusted in the reserves. Okay, reserves also we are taking in case of merger. Purchase means what? Assets, liability, whatever we are taking over, that only we are writing, that to at agreed value, sir. Sometimes assets and liabilities taken over, they'll say, but they will not give agreed value. That time book value is assumed to be agreed value. That is also fine, sir. Good. Correct? That is also okay, sir. That also we can account it. Correct? And there also business purchase is reverse, that is PC amount. Based on that goodwill or capital reserve is there. So in second entry also we are having purchase consideration. Third entry also what? Purchase consideration. If PC is computed, if what is computed, if PC is right, half of your answer is right. Clear? Because first entry also PC. Correct? First entry is also PC. Second entry also PC is required, then only goodwill or capital reserve value will be there. Third entry also PC settlement will be. If PC is right, your answer will be most of the times it will be correct, subject to other entries. Similarly, one more point, students commit mistake. What is the one more point is? What is the one more point is? They will never understand one point. They will never get the consciousness at the time of doing the sum, because conceptually they will be strong, but in that exam, that exam pressure or stress, whatever you have, having that anxiety, we will be with when one flow, we will what? Eliminate mutual owings before second entry. Don't do that. Pass all the 3 entries. And if there is any amalgamation adjusted reserve, pass the 4th entry. After that only you have to do the intercompany eliminations. Clear agana? Other than that, before that you don't even touch. Clear agana? After that only you have to bring everything into consideration. Therefore, 3 things: PC calculation should be perfect, 1, 2, 3 should be perfect. After that only intercompany elimination you should do receivables, payables, okay, creditors, debtor, loan liability, loan taken, loan advanced, correct, and unrealized profit, liquidation expenses, debentures, everything should be eliminated. These are the maximum adjustments they'll be asking. Same will be there in consolidations, okay, with the small differences, okay. Able to understand, sir, means if PC is done, everything is done, sir. Yes, my everything is done. We will take a few more questions, kana. Okay, if anything appears like this is ICA study material question, we will take up. Okay, quickly I will explain you guys. Okay, listen, sir, 16th question. What about first few questions, sir? Okay, you written some questions, that is fine. What about few questions? PC calculation we will learn at the end, kana. Okay, we will learn at the end, because first we will complete the big ones. Okay, PC and all very easy. What you pay to equity shareholders, preference shareholders alone will be considered for PC calculation. Listen to me. This is ICA study material question. Super question. Good question. Smart, cute, sweet, clear. Listen. Equity and liability. What is that? Equity and liability. They have given share capital, resources surplus, non-current liability, trade payables, and assets also PPA. They have given non-current assets, investments. Okay. And current assets also they have given 240, 420 and everything they have given. Okay, share capital they have given the notes to accounts. In share capital we are having equity shares as well as what? Preference shares. Okay, so P limited, Q limited, every amounts they are giving, long term borrowings, everything they have given. And something I have written here because there are adjustments, I will tell you that also. And breakup of trade receivables and trade payables they have given. Listen to me. PP of both the companies are to be revalued, are to be what ma? Revalued at 15%. Okay, PP of both the companies are revalued at 15% above the book value. That revalued you have to check above or below that. Okay, revaluation profit or loss that you have to consider. Clear? Clear? And both the companies are to pay equity dividend of how much? 10%, but preference dividend I have already paid. Means they are talking only about what are equity dividend. After about transaction, after this transaction are given effect, then after this only amalgamation starts. Okay, P limited absorbs Q limited. What is that? P limited absorbs what limited? Q limited. Sir, absorption extent required or not required? Just to go in a flow. Okay, that and all not required. Okay, clear agana? On the following terms. What are the following terms? Is 8 equity shares of 10 each will be issued by P limited at par against 6 shares of which limited? Q limited. Against 6 shares of what? Q limited. Sir, equity shares is given, sir. Therefore, PC calculation we can consider. 10% preference shareholders of Q limited. Okay, point number 1 is who is acquiring who? P limited is will absorb Q limited. Therefore, this fellow is what? Purchasing company. Will absorb Q limited means that fellow is what company? Selling company. So, let's think like P limited. Let's think like what limited? P limited, because they are asking from the viewpoint of past journal entry in the books of purchasing company and also purchase consideration, how much we have to pay. Clear? Easy to the core. Clear? Sir, purchase consideration, what you said, sir? Equity shareholders, preference shareholders, whatever you pay, that should be considered for PC calculation. Yes, sir. Okay, this is equity shareholders payment, this is preference shareholders payments. Clear? What we are paying to equity shareholders is what we are paying 8 equity shares of 10 each will be issued by P limited at par against 6 shares. Okay, clear? So for every 6 shares, 8 shares will be given. Preference shareholders also will be paid at 10% discount by issue of what? Preference shares of 100 each at par. Okay, after let's read full question. Okay, next this is for PC calculation, this is for PC calculation. Third, 12% debenture holders of Q limited are to be paid 8% premium by 12% debentures. Means simple, whatever is the debenture amount. How much is the debenture amount of Q limited? We have to check. Correct? Debenture holders, where is that? 1,50,000 is there. 1,50,000 we are paying as 150. 8% premium we are going to pay. We are going to pay more. So that extra we have to pay. So that we have to remember. So this is regarding to debenture holders, not for PC, not for PC, not for PC. And 30,000 is to be paid by P limited to Q limited for liquidation expense. Correct? So purchasing company is paying the liquidation expenses. Clear? Sundry creditors. Okay, this is liquidation expense. And one more question is this: sundry creditors of Q limited include 10,000 due to P limited. Creditors. What is the entry we have to pass to eliminate sundry creditors to sundry debtors? It can be any company. Sundry creditors of Q limited. What limited? Q limited. And this will be what limited? P limited. What is the amount? 10,000. So you have to eliminate only what? 10,000. My question is whether you will pass first entry itself after PC, that entries you have to pass. After PC entry you have to do. Don't eliminate now itself. First to bring all the creditors, everything. Accordingly, PC will be done, goodwill and capitals will be calculated. After that only you have to eliminate. Clear? And last one, inventory in trade and debtors are to be taken 5% less than their book value. The moment you see this line, 5% less than their book value, means they are touching the book value, they are not taking at book value. They are not taking at book value. They are not taking at what value? Book value. The moment they are not taking at book value, it is called as merger or purchase. Purchase. For merger, it should be taken at what value only? Book value only. Correct? Means when are you getting clarity whether this is merger method or purchase method is by seeing the last line. By seeing what line? Last line. Clear, Amma? Clear? Even though they are telling P limit, assume we are P limited, we are acquiring Q limited, means entire business we are getting. Entire business. Absorb. Business means all assets, all liabilities you are bringing. Clear? Now by seeing this you should not come to conclusion merger or purchase, because they are telling absorb means all assets, liabilities we are bringing in. Correct? But they are telling it is less than book value, means here itself they are telling it is what method? Purchase method. It is what method? Purchase method. So the second most important thing for any sum is you have to look into the requirement of the question. You have to see what of the question? Requirement of the question. The requirement of the question we are seeing. Correct? Pass the journal entry in the books of purchasing company. What is a PC? Let's calculate PC first, then we will come back to what are journal entries. Clear? So what are the things we are paying is, we are giving to equity shareholders also, we are giving preference shareholders also we are giving. Sir, for equity shareholders what we are giving, sir? We are giving only 8 equity shares for every 6 shares sales. Cash is not given. Clear? So how many equity shareholders are there in which company? In the selling company Q Limited. In the selling company Q Limited, there are 3 lakh rupees worth of equity shares. Correct? Means each 10 rupees means how many shares? 30,000 shares. Similarly, this is 100. 1 lakh means how many? Correct? 1000. Therefore, 1000 into 100 comes to 1 lakh. Correct? So, equity shareholders, we are giving what? Equity shares. Correct? So, 30,000 into, for every 6 shares, 8 shares are given. Therefore, how many 1000 equity shares we are giving? 40,000 equity shares of how much? 10 each. So 4 lakh. For preference shareholders, we are giving it discount. If you remember, we are giving it what? 10% discount. Correct? 10% discount. So issue price is face value 100. 10% discount means the issue price is what? 90. Therefore, correct, ma? Therefore, how much it is going to be? 1000 into 1000 preference shares as per the balance sheet into 90, which comes to 90,000. So total PC comes to 4,90,000. Correct? So total PC comes to 4,90,000. Therefore, what is the journal entry for PC? Business purchase account debit to what? Liquidator of that Q Limited. Vendor company name is Q Limited. 4,90,000 and 490. But before this, there were 2 adjustments. They have given revaluation profits. That is revaluation, asset revalued, as well as what revalued, ma? Dividend declaration is there. Correct? But since they are saying both the companies, correct? Both the companies have revalued, both the companies have paid the dividend. But the requirement is we have to pass journal entry only in the books of P Limited for this sum. Correct? Therefore, let's do revaluation. First, let's do revaluation as per journal entries in the books of P Limited. As per balance sheet of P Limited, P Limited's PP book value was 7 lakhs. 15% increase. So 7 lakh into how much increase to 15%? What is the journal entry will pass at the time of revaluation reserve? PP account debit to revaluation reserve. So 7 lakh into 15% how much? 1,05,000. 1,05,000. Therefore, when I prepare a balance sheet after amalgamation, my value of asset after amalgamation will be 7 lakh plus increase of 1,05,000, total 8,05,000. But in this question, they did not ask any balance sheet. If they ask balance sheet after amalgamation, it should be 8,05,000 for P Limited. Clear? With that, Q Limited should be added. Clear? Hello? So this is for revaluation. Then they are paying dividend also. Correct? 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 Generally, what is the entry for dividend? Is dividend account debit to dividend payable. Next, dividend payable to bank. Okay? Dividend payable to bank account. Clear? So dividend account debit to dividend payable. Dividend payable account debit to, okay, dividend payable account debit to bank account. Clear? Hello? this being a nominal account, this is closed and taken to what? P and L, or I can write it as reserves and surplus. I can write it as reserves and surplus. Okay. So we are which company? P Limited. P Limited is paying what? Equity. They have given no 10% equity dividend. Preference is already paid. Don't worry. Clear? Both companies they are telling. So we are in purchasing company. In our books also we have to do. And more importantly, after this only amalgamation takes place. That's why these entries are passed first. Clear? Point number 1 for P Limited, for the purchasing company, what is the share capital we are having? 6 lakhs. So we are going to pay dividend. Dividend what rate as per the question? 10%. So 6 lakh into 10% how much? 60,000. Therefore the entry will be dividend account debit in bracket reserves and surplus account debit to dividend payable 60,000 60,000 dividend payable to bank 60,000 60,000. Clear? Instead of writing dividend in bracket reserves and surplus, they have written what? Reserves and surplus to dividend payable. They are writing it as what? Equity dividend. Correct only. That is also correct. Clear? So reserves and surplus account debit to equity dividend. Next entry is what? Equity dividend to bank. Dividend payable you can write it as. Clear? So 10% this you are writing. So after these two only we are starting the amalgamation. So business purchase account debit to liquidator of Q Limited. Liquidator of what limited? Q Limited. Clear? So this they are writing 490 and 490. Clear, ma? This you would have told. Correct? Now we are taking up. This is amalgamation in nature of what? Purchase, because they are not taking at book value. Clear? Point number 2. Sir, they are telling absorb. No, means all assets they would have brought. Correct? So all assets we would have bought. Every asset we would have bought. Okay. But since it is amalgamation in the nature of purchase, how did we find it? Because assets are not bought at what? Book value, it is less than book value. Therefore, it is purchase. And they are telling absorbed. Correct? Absorbed means what? All assets at what? All assets, liabilities we are bringing it, but write it at agreed value. But only for these two they are giving the agreed value, no sir. But others they did not give agreed value. Since they did not give agreed value, shall we eliminate? You should not eliminate. This is absorption. Means what? Absorption. All assets, all liabilities you have to bring, but at agreed value. If agreed value is given, take that value. If agreed value is not given, as I am telling you from the beginning, book value is assumed to be what value? Agreed value. Clear? So only inventory and debtors is taken 5% lesser. That too, how to pass the journal entry, I'll tell you. Listen, inventory slightly you can reduce 5, but debtors, first you have to debit full debtors. For this 5% you have to create PDD. Just like that you should not subtract here. Clear? Show separately PDD. So how the entry will be is, first we will see what are all the assets we are having. PP, this is Q Limited, correct? So PP, non-current investment, inventories, trade receivables, cash and cash equivalents. Only for these two we are having what? 5% less. Others we are bringing in the same value only. Clear? So property, plant and equipment. Property, plant and equipment also revalued is there now. 250 into 115%. That also the increase. So 250 into 250 plus 15% also you will get the answer, or into 115% if you do also you will get the answer. How much you are getting? PP 2,87,500. Correct? So this is agreed value or revalued amount will take. Other than this, what are the two more assets for which they are giving the agreed value? Inventory they gave, debtors they gave. Inventory as per the book value is 3,20,000, 5% less they are taking up, so 95%, or 320 minus 5%, how much? 3,04,000. Debtors actually book value is 190 only. Sir, you only said no 190 minus 5% because agreed value 5% less only. No, correct? That they are showing separately. Are you able to see it? 1,90,000 into 5% PDD, that is provision for bad and doubtful debts. So they are showing that only. Less only they are showing, but differently they are showing it. Clear, Amma? Clear? What about the other assets for which they have not given the agreed value? Sir, take the book value as what value? Agreed value. So same values you are taking. Clear? Creditors also same value you take. Debentures they are told no 8% extra premium as per the adjustment number 3. Correct? Adjustment number 3, 8% premium. So 150 plus 8% the agreed value, because it is amalgamation in nature of purchase. That's why agreed value you are taking. Clear? And bills payable, since they did not say anything, I'll take that book value as what value? Agreed value. After taking up all the assets and all the liabilities at agreed value or book value agreed, assumed as agreed value, reverse the business purchase. In this sum, you will get the difference in the credit. The credit is called as what? Capital reserve. So, in the amalgamation in the nature of purchase, second journal entry, we are having what? Capital reserve of how much? 80,000. So, we passed what? First, business purchase account debit to liquidator, then the assets we are getting. Next, PC settlement entry. Correct? Liquidator of Q Limited account debit to equity share capital, preference share capital as per the working note. How much is the equity share capital? 4 lakh. This is what? 90. So 4 lakh and 90,000. 4 lakh and what? 90,000. This will be done. Clear up? Yes or no? And adjustment number 3. Okay, we will re-see that, we will look into that once again. 12% debentures are to be paid at 8% premium. Correct? By the word is there now. Actually, we know we have to settle that fellow how much ma 1,62,000 for the debenture holders. We have to settle. How are we settling? Cash or any other securities or debentures itself we are giving. They are telling, array I am settling by 12% debentures, but I am issuing at a price of 10%. So issue price is not 100. Issue price is 10%. Issue price is what ma? 10%. So number of debentures to be issued is equal to 1,62,000 we have to give. Correct? But issue price is what? Our share value is 100 or 90 is the share value, 90, 10% reduced to discount. Correct? Therefore 1,62,000 divided by 90. How many debentures we have to issue to settle 1,62,000? 1,800 debentures of 90 each I have to give. So 1,800 debentures of 90 I have to issue. Correct? Correct? Then only you can settle 1,62,000. But to settle this much, my debentures are actually how much? 100. So my debentures face value is how much? 100. To settle 1,62,000, I have to give 1,800 debentures of 100 each only. If I give that much only, how much is settled to them? 162. But sir, to settle this, we are giving this much. This much liability we are accepting. Sir, yes, ma'am, we are accepting this much liability. That's why it is called as loss, which will call it as discount on issue of debentures. The discount on issue of debentures being a loss, we are debiting. We are what? Debiting. Clear or not clear? So the entry is, okay, always remember, to settle this, we are issuing debentures worth of 1,80,000. Clear? So we have to do it. Always remember, number of securities to be issued is equal to what we have to pay, PC or amount to be paid, divided by issue price, divided by issue price. To settle 1,62,000, we have to issue 1,800 debentures of 100 each. If you issue that only, you can settle what? 1,62,000. Because our debentures are not traded at par, it is what? It is issued at discount. Clear? 18,000. Clear? And after this, in mutual owings, that there itself we pass the entry. You remember when I was teaching the sum, sundry creditors to sundry debtors, 10,000 is the mutual owings. Clear? Then liquidation expenses we have seen. Okay. How much is the liquidation expenses as per the question? Liquidation expenses is 30,000. Amalgamation in the nature of purchase? No. What I said, amalgamation in the nature of purchase, liquidation expenses depends upon second entry. Second entry is capital reserve. Then the liquidation journal entry should be what? Capital reserve account debit to bank account. Capital reserve is how much we are paying? 30. How much we are paying? 30. Clear? So you are telling you are having a profit of 80. No, in that 30 you are paying. So your capital reserve is no longer 80. It should be only 50. So in here they would have passed two entries, consolidate and pass one single entry, capital reserve account debit to bank account, 30 and 30. So after this capital reserve starting you got 80. You thought you are very happy, but they are asking you are giving 30. In net your gain is only how much? 50. So for that you are reversing the capital reserve 50. Clear? So with this, that particular sum is completed. Let's proceed with further question. ICA study material. This sum I will come little later. Okay, one easy sum also will take. All are easy. Actually, everything is easy only. Just you need to practice. Amalgamation is easy actually. Provided, please practice and have these notes. Take the printout, have these notes, repeatedly see. Okay, so that you will have the clarity. Okay, listen. Let me take you guys to one sum called as the following are the balance sheet of P Limited and V Limited. This sum is very good sum only. Okay, not complicated, nothing, easy only. Clear? Equity and liability, shareholders funds, everything they have given, share capital, reserves and surplus, long-term borrowings and trade payables, and everything is fine. And the notes to accounts also they have given. Share capital, the reserves and surplus, foreign project reserve, general reserve, everything they have given, all are fine. Okay, P Limited, V Limited. Assets. All the bills receivable held by V Limited were P Limited acceptances. Were what limited acceptances? P Limited. All the bills receivables held by V Limited. All the bills receivables held by, come on, all the bills receivables held by which company? What is that? Held by V Limited were from what limited? P Limited. Correct? P Limited. See, for one company bills receivable means other companies it should be what? Bills payable. Correct? So here they are having 120. But common is only 80. So when I eliminate, I will eliminate 120, 80 only I will eliminate. Correct? Therefore, out of this 120, 80 is with what company? V Limited. Correct? So mutual owings is this. When I pass the entry bills payable to bills receivable, I should eliminate only 80. So this point you have to remember. Clear? Listen. Now they are telling something. On 1st April, P Limited took over V Limited in an amalgamation in nature of merger. They themselves they are given what method name. It was agreed that discharge in discharge of PC for the business of P Limited. Who has taken over who? P Limited has taken over what limited? V Limited. Clear akkada? So P Limited is purchasing company. B Limited is selling company. Clear? Okay, listen to me. It was agreed that in discharge of consideration for the business of P Limited, we would allot 3 fully paid equity shares of 10 each for every 2 shares. What is the ratio? 3:2. For every 2 shares, 3 shares are given. Okay, and it was also agreed that 12% debentures of V Limited would be converted into 13% of the same amount. Means no extra. We are going to pay same number only we are going to pass. So see, these things and all, second entry you should not consider, third entry you should not consider. After every PC calculation, then only you have to pass the old debentures to new debentures. Clear akada? Clear? So old is 12%, new is 13%, that also will pass. Details also they went. Expenses of amalgamation of 1 lakh were borne by the purchasing company. Clear? Clear akada? This is amalgamation in the nature of purchase na. Therefore the entry should be what? Reserves account debit to bank account. Requirement of the question. Pass a journal entry in the books of purchasing company and balance sheet after merger. Balance sheet after dash. What is that? Merger. Shall we start? First we will calculate what? PC. My question is, what is the PC calculation? We are issuing only what? Equity shares to the equity shareholders. In what ratio? For every 2 shares, 3 shares are issued. Okay, how many shares are there in V Limited? Totally 6,000 lakhs in value itself. So 6,000 for every 2, we are going to give what? 3. Correct? Correct only, no? Where is that? Where is that? We would allot 3 shares. Correct. Okay, therefore PC is for every 2 shares, 3 shares we are going to give. So 6,000 lakhs is the value. 1 share is 10 means totally how many shares? 600 into 10. Total 6,000 in value. 6,000 into 3 by 2. Total PC value is what? 9,000. Take calculators and check. 6,000 into 3 by 2 comes to how much? 9,000 lakhs. Amounts are in lakhs as per the question. Therefore, what is the journal entry? Business merger account debit to liquidator of E Limited. But sir, they are using business purchase. No sir. I said no, anything is fine. You can pass. Okay, this is amalgamation in nature of merger. Merger rules are what? What method? Pooling of interest method. Under pooling of interest method, what we will do? All assets, liability, reserves, you have to bring it at book value. Reserve alone you have to adjust for what? For that extra payment when compared to paid up capital. Clear? Correct? So all assets will bring it. Whatever assets we are having, just we will see. For the name's sake, we will see the assets, amount and all, we will just do it. Okay, so assets, what are all the assets we are having? This is what company? Okay, selling company assets only, no? PPE, inventory, trade receivables, cash and cash equivalents. Okay, and PP itself we are having breakup of land and building, but for selling company, land and building is not there. Plant and machinery we have, furniture and fixture. Everything should be taken at what value only? Book value only. Everything should be taken at what value? Book value. So all the assets, whatever you are seeing in the balance sheet, everything is taken at what values? Book values, including liabilities. Including what are liabilities? In what value itself? Book value itself. In what value? Book value. Why sir book value? Because it is amalgamation in the nature of merger. Clear? Clear? Including provisions you are taking. Provisions also I have seen in this. Okay, provisions, see 702. Clear? Provisions also you are taking. Along with that, reserves also we have to take. Okay, foreign project reserve, general reserve, P&L. As I said, general reserve alone, don't write it, have it in mind or somewhere you write in the pencil. Everything will write. Okay, all the reserves. Okay, all the reserves you are writing and liabilities you are writing. Will reverse business purchase also. You remember one small trick I taught you? Write everything except what? General reserve. Whatever is the difference, you write the difference. Or logically how to understand? Actually reserve balance is 3,200. Correct? Now let me see. What is the selling company's paid a capital? 6,000. But how much we are paying? 9,000. We are paying more. How much more we are paying? 3 lakhs. 3,000 lakhs. How many lakhs? 3,000 lakhs. I told you now merger is seen as a non-event. We are paying to ourselves extra. Means it is treated like a bonus. Adjust in the reserve. So reserves we have to adjust. How much we have to adjust? 3,000 we have to pay more. Since we are paying more, I told you no. If you pay more, subtract from the reserve. If you pay less, sir, like 6,000 sir, but we are paying only 1,000, then increase the reserves. Clear? Already 3,200. If you are paying less by 1,000 means increase the reserves. So 4,200. So what ma? 4,200. In this sum, we are paying less, correct? We are paying more. So when you pay more, your reserve should be subtracted, treated as what? A bonus given to the shareholder, reduce the reserve. Bonus, other name is what? Capitalization of reserve. So they would have already given everything and we are bringing it back. Clear? They have paid, that's why their reserves are adjusted, not our reserves. Clear? Clear or not clear? So everything is completed, and when you make the payment for PC, only equity share capital we are giving for this sum, liquidator to equity share capital, okay? And liquidation expense 1 lakh we have seen. No, this is amalgamation nature of what? Merger. Therefore entry is what? Reserves account debit to bank, something and all they'll write, just pass reserves to bank. Clear? And old debentures to new debentures, and mutual owings of only 80 should be subtracted. After everything after that balance sheet they're asking. Put the balance sheet, combine ours and theirs, and whatever you're rushing. Already we are having 50, new equity share capital 9,000. That reserves and surplus. What is that? Reserves and surplus. Okay. Our reserves and surplus already we are having how much? P limited 3,000, 9,500, 2,870. That is 15,370. Their reserves also there, but adjust for what? That 3,000. So that amount only I would have written here. Okay. Pause for a second, make a note of it, and everything you'll understand. And reserves we have adjusted for what also? Liquidation expenses also. So think and do it. Clear? And general additions only have to do. Clear? And always remember, this will be useful for financial statements of a company. I'm going to make videos on what I don't know how many of you are waiting for that, but many messages I'm getting that, sir, please financial statements, consolidation, branch accounts, sir, that I'm going to do in upcoming days. 200% I'll give clarity. In revision itself, I'll try to give maximum clarity possible, so that I want you to score. That's the only happiness I'm having, that. So we are striving for giving clarity in the revision session itself. So make sure you are doing it after seeing the class. Okay, please make sure you are taking little break. Immediately you are solving the sum. For that purpose only I say study materials are there. No, they are always most of the sums are repeated in MTPs and RTP in past exams. So very good sums. Okay, please do it once. Okay or not okay? That's why I'm teaching with clarity, conceptual clarity. Concept if it is there, no, you can handle any sum. That's why I'm teaching for, concepts also I'm teaching. Okay, listen to me, sir. Before that, one sum is there, no, sir, that we will take up. Wait, that sum will take one more sum in one flow. I'm going. This sum, Sun Neptune Limited, super question. I love this question. This sum we have completed now. Okay, this is practical question, practical book back question. It will be Sun and Neptune. Why, sir, everything you have given here? Because in one flow, if you read now, you can complete. In study material, you have to turn the page. That this and all you have to do. So I'm giving here itself so that it will be easy for you, ma. Clear? See, Sun and Neptune Limited had been carrying on the business independently. Means they are doing the business separately. They agreed to amalgamate and form a new firm. I told you, starting opening itself, I thought you when two companies liquidate and form a new company, that process is called as amalgamation. Amalgamation. Clear? Therefore, here there are two liquidating companies, there are two selling companies. So two business, two PCs will be there, two goodwill or capitalist or what is there, we will check. I also don't know. Let me see. Clear? Okay, I also don't know means I know this. I am going to teach you. Clear? Listen. Okay, this new company is called as Jupiter Limited with an authorized share capital of how much? 4 lakh, which is divided into 80,000 equity shares. People will miss on this, it is not 10 rupees, 5 rupees share. Okay, ba? So authorized capital is 4 lakh rupees, which is divided into 80,000 shares of 5 each. On the 31st March, respective information of Sun and Neptune were given. Share capitals of Sun and Neptune, current liabilities they have given, PP value, PP values, and the current assets value they have given. Additional information. They are telling, even though I am giving you the information of Sun and Neptune, I have revalued two people. I have what? Revalued these two. Okay, PP and the current asset. The moment you see revaluation, okay, what you have to think, merger or purchase? Merger, correct? I will jump from here. Correct? Merger or purchase? Purchase it is the moment you see revalued numbers. Clear? Debtors and creditors include 43,350 owned by Sun to Neptune mutual owings. Once again, I'll ask you, mutual owing should be eliminated in the second entry itself. Correct? Ante, I will cry if you say, sir, after elimination I'll calculate PC. That's it. I'll cry because PC will be fixed based on everything. Correct? After that entries only have to do. In this video itself, I would have told many times. Even in revision itself, revision. Clear? So make sure you don't forget. Whenever you see sums and in exam you are doing, no, Sathya sir, why should this? Hey, mutual owings don't eliminate now. Like cross third entry, fourth entry, then you do whatever you want to do. Clear? So mutual owings we are going to eliminate. Okay. Masterpiece in this sum is what is this particular adjustment. Very easy, very chips packed for us. I'll straightly tell the answer. Okay. This is actually talking about PC. The purchase consideration is satisfied by issuing shares. First part talks about shares and also given not debenture holders. It is given to shareholders only. To shareholders, equity or preference shareholders, whatever you give, whether debentures if you give also it will be considered for what? PC. But for debenture holders, whatever you are paying, that is not considered for PC. Okay. The PC, they themselves they are telling PC is satisfied by way of shares as well as debentures. So both will be considered for PC calculation. Listen. Okay. Listen. 60,000. Hey, don't deviate. See here. Okay, sir. To whom you are telling, sir? The one who is seeing the class. Okay, listen. So 60,000 60,000 equity shares of Jupiter Limited issued. See, Jupiter Limited says, "Arey, I'm a new company. I'm an Jupiter company." We should think like Jupiter company. We have to issue shares to Sun and Neptune, but we are having only 60,000 shares. Arey, I am having 60,000 shares. This only I am going to split between you both. Clear? Don't torture me to give entire 60,000 to one person. Other person will come for war. Correct? Now, what ratio I have to give? Question itself they are telling. What they say in question will do. Clear? 60,000 equity shares of Jupiter. Our 60,000 shares will be given to Sun and Neptune Limited in the proportion of profitability. In the proportion of what, ma? Profitability based on the average net profit for the last 3 years. Clear? So last 3 years profit loss they have given. Sun Limited profit loss profit. Neptune profit. So average profit means what? Add everything divided by how many years? In this sum 3 years. So Sun Limited, add everything, add minus add. So how much you are getting? 825. Clear? Divided by 3 years. So what is average profit? 2,75,000. Like that Neptune also add 3 years. 1, 2, 3. If you add everything, how much you will get? 9,75,000. We need average profit because what ratio they are telling? Average profit ratio. They did not say total profit ratio. They said our total profit means this ratio you have to take. Clear? But they are not talking about what? Total profit ratio, average profit. Take simple average only, not weighted average and all. Clear? When weighted average you have to take is, there is a sequence of increasing. Some pattern should be there. Small increase, decrease, something should be there. Increasing pattern is there. Here nothing is there. No increase, no decrease. Correct? That increase should be proper for both the companies. Then you can do weighted average. I cannot do for one company simple, other company weighted. Clear? So that's why we are adopting simple average method. So 825 divided by 3 years, 275. 975 divided by 3 years, 3,25,000. So in this basis only, in this ratio only, 275 is to 325 only, I have to divide the equity shares to Sun and Neptune Limited. Therefore, Sun Limited, Neptune Limited, 60,000 into 275 divided by what? Divided by what number it is? 400, 600. Correct? Divided by. So 60,000 shares. 60,000 shares into 275 divided by 600. 60,000 shares into 325 divided by 600. You will get what? This numbers you will get. So how many shares out of 60,000 shares we are going to give? 27,500 shares to Sun, 32,500 shares to Neptune Limited. Clear? And each shares we are giving at what, ma? 5 rupees. Therefore, how much is the amount of shares in value? 137 and 162,500. Clear? Hello, everybody. Therefore, when you are calculating PC, PC calculation, Sun and Neptune, equity shares, how much we are giving in value? 137, 162, 500. Not only shares we are giving, okay, not only shares we are giving, but also we are giving what? Debentures also. So as per first information I'll write. Info 1, this is the story. Second, we are also settling to the equity shareholders what we are giving. Debentures also we are giving. What also we are giving? Debentures also we are giving. Correct? So that also we have to calculate. Debenture adjustment is interesting adjustment. Listen to me, kada. Okay. So 15% debentures we are going to issue at par to provide an income equivalent to 8% return on business as capital employed in their respective business. Simple. Whatever capital employed they are having, Sun Limited, Neptune Limited, whatever capital employed they are having, in that 8%. correct? 8% how much ever amount they are giving. To that extent, I am going to give debentures, so that debenture interest earns 8% of the capital employed. So I am going to give to my debenture holders, like I am going to give my equity shareholders. What we are going to give is whatever is the total income, that is whatever is the total net assets or capital employed, in that 8% amount will be there. To that extent of income, to get 8% of capital employed as a return, I'll give you debentures in such a way the interest is earning 8% of the capital employed. Therefore, I should allot debentures in such a way that debenture interest income should earn 8% of the capital employed. Correct? Capital employed can also be called as net assets. Clear? So first we'll calculate what net assets we'll calculate. Correct? So capital employed of Sun, Neptune. Okay. Assets taken at what value? Agreed value. Assets taken at what value? Agreed value. So add both and subtract the outsiders liability as given in the balance sheet. Clear? So 597 and 1,80,000 as per the balance sheet. Go back to the balance sheet and check. Net assets will be, you're going back, scrolling, wait, come here. Clear? So how much is the capital employed? 412 and 367,500. In this capital employed, we are going to give debenture, so the debenture interest earns 8% of the capital employed as income. So 8% means how much? 412,500 into 8%, 33, and on this 88% is 29,400. So we have to give, to the shareholders of Sun Limited, debentures should be given in such a way that the debenture interest should give them 33,000 as income. Neptune Limited shareholders, how much we have to give debentures? We have to give so many debentures so that the debenture interest is giving them the income of how much? 29,400. Ultimate question. Same like this question only I have given in what? First few questions. I have given one sum. I think Neil Limited or Gagan Limited is there. That sum, same question only. Same like this you have to do. Clear? 8% of the return. Clear? How much we have to get? 29,400. So 29,400 we have to allot. So income should be 33,000. Income should be 29,400. Correct? So how many debentures we have to allot, sir? Like they are asking, Sun Limited, they need an income of how much? 33,000. They need a debenture interest of 33,000. To that extent, I have to allot debentures. To that extent, I have to allot what? Debentures. So debenture into debenture amount into percentage gives you what? Debenture interest rate. Correct? Debenture into percentage gives you, for Sun Limited, they need a interest of how much? 33,000. Therefore, debenture is equal to 33,000 divided by 50%. Therefore, how much debentures you have to allot to Sun Limited? 2,20,000 worth of debentures if you allot. Each debentures will be what percentage as per the question? New debentures should be at 15%. Then only they'll get 33,000. Similarly, for Neptune Limited also, how much debentures worth we have to allot? 196. So total how much debentures we are going to issue? 4,16,000. So 4,16,000 is going to be there in our balance sheet. Clear? In the Jupiter Limited, what is going to be the long-term borrowing? 4,60,000. That too, Jupiter Limited, they will not have any opening balance because it is a new company. It is a new company. So whatever is the assets and liabilities we are bringing from what company? Selling company will be assets and liabilities of new company, Jupiter Limited. So 4,16,000 we are bringing. Clear? Okay. And how many shares we are going to give? 60,000 shares of Jupiter Limited into 5. So 60,000 into 5, which comes to 3 lakhs. Capital reserve, how much we have seen? 64,000. Clear? I'll come to that also now. Listen. So 64,000, I'll come to that. So this particular point we would have understood. Therefore, how much PC we are going to pay to these people is equity shares we are paying this. Debentures 220 and 196. How much? Debentures are how much? 220. Where is that? Debentures, how much we are going to allot, sir? Debentures 220 and 196 we are going to allot. Correct? So debentures 220 and 196. Total PC is 357,500, 358,500. Correct? Now we have to check now whether we are paying more or less. We will check. Correct? Array, this method. Sir, how do we check whether we have paid more or less, sir? Okay, this method is what? Since we are taking the revalued amount, it is amalgamation in the nature of what? Purchase. Amalgamation in the nature of purchase means how to calculate goodwill or capital reserve. We have to check what is PC and what is the net assets. Okay, net assets already we have calculated. What is the net assets? 412,500, 367,500. So net asset is this much, but we are paying only 3,57,500. So we are paying less. For us it is profit, capital profit. Here also capital profit. So total capital profit which will be taken to capital reserve is so much? 64,000. That is what I have written, 64. So capital, reserves and surplus, loan, and other current liabilities we have to just add everything. Clear? So what they are asking is, in this sum they are asking how many number of debentures we have to issue Okay, and what is the balance sheet? Here they did not ask the journal entries. They did not ask what entries are journal entries. So straightly we have to calculate everything. Clear? So equity share capital 3 lakh, reserves is 64,000, long term borrowings is this, other current liabilities. What is that? Other current liability. Take everything and eliminate the mutual owings also. Eliminate what also? Mutual owings also. You should eliminate not only in the bills receivable but bills payable, but also in the bills receivable. You have to eliminate. PP should be taken at revised values. Everything at revised values. In financial statements, you have to always show one thing. Authorized capital you are showing 80. In the first line of the question, they have given this. But we are issuing only 60,000 into 5. Total comes to 3 lakhs. Correct? In this, how many shares we are giving for consideration other than cash? We have to show it separately. Then only it will be done. Clear? So this sum is completed. Let's continue further. Okay, see, we have completed what in the books of what purchasing company books when it comes to the nature of merger as well as purchase. Before we get into selling company and other calculation of purchase consideration, let me rewind something to you people. Okay, merger. What is it, merger? When it comes to merger, what is the first journal entry? Business merger account debit to what? Liquidator of vendor company. Correct? Next, what we are going to do is, for them we are going to first assets, liabilities and reserves, you have to bring it at book value. Everything should be brought at book value. For reserves only we have to make the adjustment. Correct? If you pay more, okay, if you pay more from reserves, you have to subtract. Logic, I taught you. If you pay less, for us it is profit, sir. What we will do with the reserves, increase the reserve. Credit, it will be there, no, like, no, 2 reserves you will write, na, credit in journal entry, increase the reserve. Correct? Sir, whether capital reserve we have to write or no, you should not bring goodwill or capital reserve in this case. Clear? Just reserve only AS14 as talking, because it is treating as if you are paying to yourself, no? So just reserve you have to adjust it. Clear? After that, what we have to do, we have to settle the liquidator of vendor company account debit to whatever you are paying. When it comes to, like, you know, merger, we are paying equity shareholders only through equity shares, not through any other mode. But we will give fractional shares for that portion. We will give what? Cash. Clear? Same set of journal entries for what? Merge, purchase also. Business purchase account debit to what? Liquidator, and assets and liabilities at agreed value. Reserves you are not bringing except statutory reserve. The entry for statutory reserve to record in our books is amalgamation adjustment reserve account debit to statutory reserve account, and liquidator payment and all as usual. Clear? Hello? Clear? Whether it is amalgamation, absorption or external reconstruction, answer is same. Answer is what? Same. And a mutual owing adjustments I have given. Clear? Now let's proceed with what? Selling company also. With that, after selling company, finishing we'll do with purchase consideration. Very important, like, you know, for entire amalgamation. It will be easy to the core amalgamation. I am telling you, it is very, very easy. Have my notes. Repeatedly do that. Okay? Try on your own. You will be done with this. Clear? Okay, I will teach you the selling company books. Selling company books. Okay, now let's think like morning only I said no, think like purchaser. Now time has come to think like what? Selling company. Selling company. What we do, sir? We will have assets. We will actually, selling company will have a balance sheet. Correct? Assume for our comfort zone, no, I will do the, like, you know, horizontal format first to make you guys understand. We will have so many assets. We will have what? So many assets. We will have so many liabilities along with the reserves, equity. Everything will be there. Out of many assets, few assets will be taken over by the purchasing company, few will not be taken over. So assets taken over will also be there, assets not taken over will be there. For assets taken over, liabilities taken over, we will receive what? Purchase consideration from the purchasing company. Correct? For assets not taken over, liabilities not taken over, what we have to do, sir? Assets not taken over, we have to sell it and make the money, or we can give it to, like, you know, settle any other liability or equity, and we can finish that story. Profit or loss arising out of that, we have to transfer to realization account. Clear? Same with the liabilities not taken over, that liabilities we have to settle by giving cash or asset, something we have to give. Clear? So what we are going to do, sir, in selling company, quickly we'll finish it off. Listen, whenever assets taken over, liabilities taken over is there, now for that we are receiving PC. Sir, where we have to search, sir? If everything is there in one place, it will be easy for us. That one place is what? Realization account. That one place is what? Realization account. Okay, it will be very, very easy. Listen, realization account. Assets taken over. Okay, no more. See, we ourselves, we are going to close the business. This assets will show ledger account balances. What balances shows? Debit balance. To close, what I should do? I should credit. So assets taken over should be credited. What has to be debited, sir? What has to be debited is one temporary account called as what? Realization account. Only for the purpose of closing the books of account. Therefore, realization account debit to assets taken over. Everything should be closed. Correct. A ledger account should be closed means it should be closed at what? For example, if it is 10 lakh means to close also I should write 10 lakh only. Here also I should write what? 10. So to close everything I should write it what? Book value. Here when it comes to selling company, agreed values are irrelevant. Agreed values are not required. Clear, Ama? So assets taken over at book value. Liabilities taken over at book value. So what is the journal entry? Liabilities will have what balance? Credit balance. To close it, what I should do? Debit. Liabilities taken over account debit to realization account. Correct. Therefore, liabilities taken over is what? Debited. Realization is credited. Therefore, realization account is credited with book value. So what happened? Assets taken over, liabilities taken over will be there. So we will have net assets taken over. For this net assets taken over, we will get what? Purchase consideration from the purchasing company. So purchasing company I'll be writing. Clear or not clear? So what entries we have to pass? Each and every ledger, journal entry I'm going to teach you. Listen, are you all there with me? Point number 1. First, let us talk about what assets taken over, liabilities taken over. RILT journal ledger also will make it very easy. It will be very easy. I think you people will be so fond of ledger because we are having that tendency by seeing ledger journal and all we used to get that also. At the end I have kept for you gift. Clear? So in the books of seller, in the books of what? Seller. Now let's think like a transferor, seller company, transferor company, vendor company. Okay. First, transfer assets and liabilities taken over. TO means taken over here. So taken over to realization account. To assets I want to close credited. Liabilities I want to close debited. Therefore entry is realization account debit to assets taken over account. And liabilities taken over, liabilities account debit to realization account. Clear up? Point number 1. Certain points I'm going to tell. Listen to me. Any provision created against the asset, for example, depreciation for a plant and machinery is there. Accumulated depreciation will be there. Whether that should be subtracted and shown in a net amount or gross values only, gross value only. So plant and machinery, if it is 10 lakhs, against which if you are having what accumulated depreciation means you have to transfer to realization 10 lakhs separately. Any provision created against an asset should be transferred like any other liability, so that if you transfer this at 10 lakh and provision also, if you transfer provision for asset to realization, okay, so that what happened in realization, assets will appear at gross, relating to that provision will also appear in the opposite side, so that information will be available. So all the assets and liabilities should be transferred at gross amount. Any provision created against an asset should be transferred like a liability. Any provision created against liability should be transferred like an asset. Clear? So that gross values will be shown. Clear? Hello? Clear? So point number 1. So assets, any provision against an asset should be transferred like a liability. Any provision created against a liability should be transferred like a asset. Clear? Everything should be transferred at what value? Book value individually. Sir, why are you writing individually, sir? Each and every ledger should be closed. Correct? So practically thinking, plant and machinery should be credited, closed. Land and building should be closed. Each ledger should be closed. That's why individually they will write. Clear? For that reason they'll write that to close book value only. Book value 10. If you close at 10, once again difference. What you will do with the difference? Correct? Whether you are going to continue, no. So they are telling you yourself you are going to close ledger properly. Okay. Any difference will be there automatically accounted in the realization account. Clear? In regular class though each and every point I would have told. But now listen. Okay. This is also clarity only. So indirectly what will be accounted? Profit or loss will be accounted indirectly. Clear? By way of what PC will be accounted and other assets not taken over liability. I will show you. Wait. Okay. Listen. Any provision created against an asset, any provision created against an asset and any provision created against a liability should be shown or transferred like any other liability. Any provision created against a liability should be transferred like any other asset. Here we have to de-recognize or we have to take everything to realization at what value? Book value. Close the assets and liabilities at book value. Take it to realization account. Clear? Agreed values is not relevant for realization account because for that only receiving what? PC. Clear? So cash and bank balances are not required to be transferred to realization account because already they are realized form only if they are not taken over. Clear? If it is taken over means you have to write no other option. Clear? Fictitious assets should not be taken. It should be adjusted to equity shareholders. Goodwill, patents, trademark should be transferred to realization account. Clear? And any provision for taxation that should be transferred to realization because they are liability. Clear? Reserve should not transfer to realization except that portion of reserve. For example, workman compensation reserve against which if you are having workman compensation claim, that can be transferred to realization account. But reserves generally should not be transferred to what? Realization account. It should be taken to what? Equity shareholders. I will tell you that. Okay. Now, after passing this, okay, sir, what happened? Okay, PC, realization account. Assets taken over here, liabilities taken over here. Correct? Against this, what is going to be received from purchasing company? So, from the purchasing company, we are going to receive PC. Received or receivable? Receivable. Receivable is an asset, correct? From whom it is receivable? Transferring company. So transferring company account debit to realization account. Why, sir, I am writing realization? Because assets taken over, liabilities taken over, where did you keep? Realization only. No, so therefore PC due also, there where only you have to keep, there only you have to keep. On receipt, come on, what is that? On receipt. So assets taken over, liabilities taken over, PC. Net assets taken over, PC is compared. Correct? Automatically gain or loss will be accounted. That's what I was telling. Automatically it will be accounted. Sir, once it is received, PC if it is received from transferring company, whether it should be same receivable debit or it should be reversed, it should be reversed. Clear? So reverse on receipt of PC. Whatever you receive, that has to be debited. Cash, equity, shares. You should not write equity share capital, because we are not issuing capital. Equity shares you have to write. Okay, equity shares in transferring company against this. Clear? So point number 1, assets taken over, realization to assets taken over, liabilities taken over, liabilities account debit to realization account. Extra points you have to remember. Clear? And PC due from what? To transferring company account debit to what? Realization, because assets taken over, liabilities taken over, for that only you are getting PC, where these people went to realization. This also should be taken, therefore everything will be accounted in one place, so that everything can be seen in what? One place. That's why they are taking it to realization account. Clear? Step number 3, on receiving the PC, this is the entry we are passing. Similarly, step number 4, liquidation expenses, realization expenses. Sir, liquidation expenses, if we are paying, sir, realization expenses we are paying, sir, they are not bearing. Okay, what is the entry? For you it is expense. If expenses are to be borne and paid by the selling company, not purchasing company, then for us it is expenses. Any expense or income should be taken to realization account. It should not be taken to any other account. Sir, shall we take it to P&L? Right? We ourselves we are going to close the business. What are you going to do with P&L? Correct? P&L balance itself we are going to transfer to equity shareholders. So take it to what? Realization. Any expense income should be taken to realization account. Any loss or gain should be taken to realization account, because we are at the end game of the realization or the seller company. So realization account debit to bank account. Clear? Sir, we are if these expenses are reimbursed by the purchasing company, sir, we are paying, sir, they are going to reimburse, sir. Okay, then accountancy say, okay, if you pay, what is the journal entry? Realization to bank. Assume 1 lakh is the realization expense. Clear? Out of 1 lakh, assume these people are promising 60,000, they are promising 40 only we are going to bear. Correct? So realization to bank, you are paying 1 lakh. In that they are going to reimburse 60. Your expenses only 40. Your expenses should be taken to realization. What is receivable from them is written as transferring company. When you receive that also, that entry is what? Bank account debit to purchasing company. Sir, can we pass net entry? 100% you can pass net entry. On reimbursement, you can pass the same single entry, you can pass. Clear? Hello, this is part number 4. Okay, next part, assets not, sir, assets taken over you said, liabilities taken over you said, PC due you said, received okay, liquidation or realization expense. Okay, now what about the assets not taken over? Assets not taken over, liabilities not taken over. They are telling whatever assets not taken over, still we have to close the ledger accounts. Okay, so these assets derecognize means sell, make the money, or give it to settle equity shareholder or preference shareholder or any other liabilities that are not taken over. Okay, sir, assets value 100 lakhs, sir, but I realized only 80 lakhs. There is a loss of how much? 20 lakhs. Take that loss to realization account. Clear? Sir, assets value is 100 lakhs, sir. I was settled a liability of 115 and I am telling them, see, already I am closing. I know I have to pay 115, but I am having only 100 lakhs. Take it and finish it. So there is a gain in settlement, sir. That should be taken to what? Realization account. Clear or not clear? Similarly, liabilities not taken over, we have to settle. So liabilities should be reversed. Liabilities, when it is clear, now liabilities to bank. Correct? Sometimes what happens? Liabilities, who will take care? I have a preference shareholder say I will take care. Equity shareholder say they will take care. Correct? Any difference, profit or loss on settlement of liability should be taken to realization account only. Clear? Therefore, realization account. I will show you a ledger account first. Clear? If I show you the ledger account, realization account. Okay, realization account, Okay, realization account debit to asset account, assets taken over, liabilities taken over. If you see this, what are you able to see? What I am able to see, are you able to see? Check that. Okay, so in this, if you see, what are you able to see? Net assets taken over. For net assets taken over, what are you getting? PC. So with this, which story is completed? Up to this, whose story is completed? Taken over story completed. Relating to assets not taken over, liabilities not taken over. Correct? Assets not taken over, what we will will do? We will sell and make the cash. We will give it as a part settlement of preference shareholder, equity shareholder, any liability. Correct? There also will get gain or loss. Profit means realization credit. Loss means realization debit. So realization can be credited. Assets, profit on assets not taken over. Two assets, loss on assets not taken over. Similarly, liability second right, loss on settlement. Losses and all should be debited. Gain should be credited because of journal entries and the way in which it is transferred to realization account. Clear agana? So losses, whether it is assets not taken over loss or liabilities not taken over loss, should be a loss, should be debited, and the profit should be credited. Clear? Well, clear. Similarly, transferee company. Okay, what company? Transferee. Due entry we passed. You remember transferee company account debit to realization account. PC due entry, journal entry number 3. When you receive amount, journal entry number 4, what is the entry we are passing? Cash, bank, equity shares, preference shares, debentures account debit to transferee company. So this part is done. So this ledger is completed. Clear? Transferee company. Hello. Now let me proceed further. Okay, sir, we are done with assets taken over, liabilities taken over, PC due, PC received, liquidation, realization, expense done. Assets not taken over, liability not taken over, and their profit or loss. Okay. Now we are left with what, sir? Slowly you have to start repaying the people. Correct? Settle the debenture holders if it is not taken. Debentures are considered as what? Liabilities not taken over. So liabilities taken over, not taken over is covered under which step in this particular step itself. Correct? So after all the liabilities now starts with what? Now we have to settle preference shareholders. Correct? So preference shareholders, they will be shown as a what? Preference share capital. So the credit balance to settle I am debiting. So book value. Okay, I may pay them more. I may agree them to pay at premium also, less than that also. Correct? For example, 10 lakhs I have to pay, and I am agreeing them to pay at a 10% premium. Correct? So payable to preference shareholders is what? 11 lakhs. So we are agreeing to pay 1 lakh more. Loss, take it to realization. Sir, this also loss to profit will be there. Hey, come on. So preference share capital account debit, preference shareholders account debit, whatever you are going to pay. That's why each and every word you have to say book value. What I have written you have to see. Clear? With what actually you are payable. Book value, profit or loss. When you make the payment to preference shareholders to bank, preference shares, any other consideration you are giving. Clear? Hello? Everybody? Okay, after settling preference shareholders, come on, now I will show you the story. After settling the preference shareholders, we will have what? Preference shareholders gain also we will have, loss also we will have. After everything, we will have last balance in realization account. If this side is more, you will get gain. Transfer it to lastly gain or loss. Who should take? Owner should take. Who are owners? Equity shareholders. So I'm not writing it as equity share capital. Repeatedly I'm telling it is equity shareholders payable. Time has come. Correct? If this side is more than this side means there is a loss to be transferred to equity shareholders. Balancing here, either of the sides you'll get. Clear? So that's why, okay, I'll show you this. That's why the entry will be transfer of, okay, listen, transfer of profit or loss on realization, transfer to equity share capital. Profit means realization to equity shareholders, loss means equity shareholders to realization account. Now everyone you paid, sir. Now lastly the hero of the company, who is the owners, we have to settle them. Correct? Same like preference share capital, equity share capital also will have the balances. So to settle I have to debit. Correct? Whether only equity share capital, along with that so many years they would have earned the profits, losses, reserves will be there. No, that reserves also should be given to equity shareholder. Therefore for equity shareholder, we should not give only equity share capital. Whatever reserve you are having, that should be given. For the first time CRR you are seeing used not only for fully paid bonus shares but also at the time of settlement, because life itself is going. Correct? What are you going to do? So debit everything, capital, reserves, everything should be given to equity shareholder, whether it is statutory, that this everything should be transferred. Okay, sir, not every time we'll have profit, sir, we'll have loss also. So fictitious assets also you said not to take there, no realization, now we have to take. Correct? So if we have to pay something to the equity shareholders means credit them. If something has to be reduced from the total payment which we have to make them is, it should be credited. Correct? So debit equity shareholder, credit these people. Means accumulated losses will reduce the shareholders claim. Preliminary expenses, all the fictitious should be written off from payments made to what? Equity shareholders. So after considering the net, what is payable will be the balance. Clear? So equity shareholders account if I prepare, What and all we have to pay? Equity share capital, reserves and surplus, sometime accumulated losses, whatever is the balance we have to settle to cash or bank equity shares. So equity shareholders account debit to whatever you are paying, it should be debited. Clear or not clear agada? With this, what is completed ra? Selling companies journal entry is completed. Therefore, if you see preference shareholders account, we have to pay preference share capital with the amount payable. With what payable ra? Amount pay. Because what entry you pass? Preference share capital account, realization account debit to realization if it is premium loss to preference shareholders. Assume 11 lakh you have to pay 11 lakh. If you settle the 11 lakhs, bank whatever you are settling you have to write. Clear ama? Same with the case of what? Equity shareholders. Okay, equity shareholders, not only equity share capital reserves surplus, but also journal entry 8A I thought you, 8B I thought you, that when it is settled. Correct agana? Journal entry 8A, 8B, journal entry number 9, equity shareholders account debit to bank, whatever is that. Clear? With this, if you understand like this, it will be very easy kana. Okay, now let us focus on ledgers first. Okay sir, what is simple only sir? Realization account, assets taken over at book value individually, liabilities taken over at book value individually, whatever is the PC. So what we'll get, the story of what out of this net assets we are getting this profit or loss will be accounted automatically. Lastly we'll get it. That is what I was telling that time also. Assets not taken over, we will pass the entry. Profit or loss alone will be recorded here because it will become so clumsy. So only profit or loss will be recorded. Even if you transfer not taken over and settlement also same amounts only, you will get profit or loss. So only profits or losses. So assets profit, liability profit, and preference shareholder settlement profit. Losses means you have to do it. Simple as sir. Ante last profit or loss like on realization should be transferred to equity shareholders, transferee company account, what is due, what is received. Clear? So preference share capital, equity shareholders, are there no preference shareholders for equity shareholders, whatever we have to pay and when we are paying. Clear? These are the entries we have to do. Clear everyone? Okay, one question I will discuss kana, Hari and Vayu Limited, very easy question actually. Okay, listen. The financial position of two companies, Hari and Vayu Limited, as of 31st March we are having. So all the data they have given: share capital reserves, non-long-term provisions, payables, non-current assets also. They have given all the assets. Now look into the share capital pattern. Whatever we are having, we'll check. Equity shares of 10 each. 10 lakh and 3 lakh, 9% preference, 10%. 9% preference is for Hari, while Limited is having 10% preference. Reserves and surplus is having, we are having only general reserve. Long term provision, retirement gratuity fund, land and building, plant and machinery, everything we are having. Okay, very easy. Hari absorbs Vayu Limited. Therefore, this fellow is what? Purchasing company. This fellow is what company? Selling company, Vayu Limited. Okay. Before we proceed with that, let me see the requirement of the question. Prepare the necessary ledger account to close the books of Vayu Limited. Means selling company books they are asking, and also show entries, acquisition entries in the books of Hari. So in the question, what they are asking is prepare ledger accounts of selling company and purchasing company journal entry. We are so strong in what? Purchasing company journal entries. Correct? Okay. First we will complete selling company, then we will finish it off. Okay. So requirement of the question we have seen. Hari Limited, only 4 adjustments are there. Nothing is there a lollipop for us. Listen, 10% preference shareholders are to be paid at a premium of 10% by issue of 9% preference shares is Hari Limited. Assume we are what company? Selling company. Okay, we are Vayu Limited. Okay, so how much is the shareholders? Say 10% shareholders are to be paid. See, Vayu Limited, we are having preference share capital. How much we have to pay? 1 lakh. But we are agreeing to pay 1 lakh. 1 lakh plus 10% premium. 1 lakh plus 10% premium. So 110 lakhs we are agreeing to pay. Loss or profit or loss, this should be taken to realization account. You remember? Shall I show you this how it will appear? Hello, listen to me. If I go to, first I will go to preference shareholders. Preference shareholders, correct? I am agreeing to pay 1 lakh plus 10,000. Total, how much I am agreeing to pay preference share capital? As well as what? Realization. You remember the journal entry? What is the journal entry? Preference share capital, realization account debit to preference shareholders account. We are agreeing to pay how much? 1,10,000. 1,10,000. So preference shareholders account should be credited by total how much? 110. It should be credited. Clear? And this was settled by what? This was settled by issuing 9% preference shares. This is Hari Limited. Therefore, this is settled. This 1,10,000 is settled by way of what? 9% preference shares in Hari Limited. What is the journal entry? Will pass preference shareholders account debit to 9% preference shares in Hari Limited. This is done. In realization account also, we have to show this loss. Correct? Loss. Loss should be debited or credited? Debited. So go to realization account. Debit, are you able to see? Clear? This is what is we have to understand. See, point number 2. Hari Limited absorbs. Absorbs means all assets and liabilities we are going to take up. Correct? Hello? Correct? What is the assets value of what company? Where is that? Vayu Limited. Where is that? This is called, okay. What is the total assets value of Vayu Limited? Shall we see total assets value of Vayu Limited? 250, 25, ante. Correct? 570. Yeah. So total sundry assets taken over. Sir, where did they say taken over? Sir, when they say observe, no, everything is taken over. Clear? And only assets will be taken over. When I say observe, liabilities also taken over. Liabilities also taken over. What are the liabilities we are having? We are having what? Wait. Correct? Liabilities we are having 80 and 20. So what is that 80 and 20? We will check. Retirement gratuity fund, and 80 is what is simply debentures. Okay, trade payables. Okay, so retirement gratuity fund and trade payables, assets taken over, liabilities taken over. Are you able to see this part? Assets and liabilities taken over. This is liability taken over. This is loss on preference shareholders. Clear? For this assets and liabilities taken over, we are going to receive what? PC. PC should be credited. The transferee company name we have to write. What company name? Transferee company name we are going to write. We will check the full question now. Okay. Goodwill of Vayu Limited is valued at what value? 50. What is it? 50,000. Sir, agreed value required as selling companies. For selling company, agreed value is not required. For selling company, agreed value is not required. Correct? When we go to purchasing company, that time we will take agreed value. Clear? Buildings are valued, plant and machinery, that and all leave. Inventory to be taken over at what? 10% less, and PDD should be created at 7.5% less. Leave that also. Equity shareholders of Vayu Limited issued necessary equity shares at 5% premium. At what percentage premium? 5% premium. Clear? This is the question they have given. Okay. Listen. In the sum, they did not give how much is the purchase consideration they have given. When we don't know how much we are paying to equity shares and preference shares, we will follow one method called as net assets method. We will follow one method called as what method? Net assets method. What is net asset method? To find PC is where how much they are paying to the equity shareholders if it is not known. How, sir? Here they have given no. What they have given? Sir, they have given no, sir. Equity shareholders of Vayu Limited will be issued necessary equity shares. They have given no, sir. Array, necessary means how many number of shares? If they give 1 lakh equity shares at rupees 10 at a premium of 5%, means that I can know. Number of shares is no. Issue price I know. I can multiply and get the answer. Necessary means what? I don't know. Correct? Therefore, here I cannot follow that method. That method is called as net payment method, where exact number of shares, where payments made to equity shareholders and preference shareholders are clearly known. Then we will follow one method called as net payments method. Where it is not known, where net payments method is not possible to apply, then we'll follow what method? Net assets method to find PC. To find what? PC. After this sum, I will discuss that PC discussion also. Let us be a bonus for you. Clear up? Listen, see, sir, here net payments is not possible, sir. What is not possible? Net payments is not possible. Wait, here net payments method. What payments method? Net payments method not possible because they did not give clearly how many shares at what value we are giving to equity and preference. If that is not possible, then straightly we will follow what method? Net assets method. What is net asset method is we have to take assets at what value? Agreed value or revalue value or revised value, whatever value they are giving, minus all the outsiders liability you have to take. Clear? Liability you subtract, then whatever number you get now, that is called as net assets, which is equivalent to PC. In this question, we will take up all the assets. Okay, all the assets at agreed value. Even though you are selling company, PC is common for everyone. Okay, so like only for realization account you have to take book value. For realization account you are not required to take agreed value. But for PC calculation, net assets method, we have to take what value? Agreed value only. Clear? So what are the agreed values as per the question is? They have told no, goodwill we should be taken at 50,000 value. Building should be valued at 150. So 50 plus 150 plus 160. Inventory should be taken as 10% less. PDD should be created at 7.5. Inventory value will check. Okay, we have to check Vayu Limited. Vayu Limited's inventory. Where is inventory? 75. That we are going to take 10% less. Here also we are going to create 7.5% PDD. So accordingly we are going to take. If you go back and see the PC calculation will have marks. Okay, so take all the goodwill, building, machinery at what values given in the question. Clear? That is how net assets will be there. Clear? Inventory should be taken at what should be taken at 10% less and PDD should be created. What should be created? For debtors, PDD should be created. Cash at bank 20,000, you take it. So what is the total assets value? 630. From 630 subtract these two, 20 and 80 as per the books, because that is assumed to be what values? Agreed value. If agreed value is not there, book value you have to take for net assets method. Clear? So from 630 if you subtract 1 lakh, what is the PC? 5 lakh 30. Correct? In this 530, see, PC is what we pay to equity shareholders and preference shareholders. For preference shareholders, in the question itself, in the first subdivision, we saw now 1 lakh plus 10%, we are going to pay 1 lakh 10. So out of 530, 110 is for equity, that is 110 is for preference share, means how much is for equity now? 4 lakh 20 will be for equity. This is balance sheet figure for them. So total PC for the equity shareholders 530. Out of that, for preference shareholders, how much we are giving? 1 lakh 10 we are giving. If 110 is out of 530, 110 is if it is for preference, the balance will be for equity. Correct? Yes or no? So 420 is for equity shareholders. 420 is for what shareholders? Equity shareholder. For this 4 lakh 20,000, these people are issuing at a premium of what? 5%. Premium of what percent? 5%. So 4 lakh 20,000 divided by what is the share value? I think 10 rupees. 10 plus 5%. Whatever number of shares you'll get 40,000 equity shares. You'll get what? That many shares you have to calculate. That many shares you have to take it for consideration. Clear? Hello? So that particular point you have to remember. Therefore, PC for the, transferee company, how much we are going to receive? 110 and that net assets, 110 and what? 4 lakh 20,000, total 530. So what entry we will pass here? Correct? Transferee company account debit to realization account. So transferee company, where is transferee company? Hari Limited. So 5 lakh 30 and they are settling for preference shareholders 410, for equity shares 420. With this ledger is completed. Correct? So this also completed. Correct? So everything is fine, and whatever is the net profit or loss, here you are getting this side difference, this side is what? Profit on realization, which should be closed and taken to equity shareholders account. Therefore, if it is debit, means equity shareholders account, it should be credited. Okay, credit 50,000. Clear? So for equity shareholders, always will give equity share capital, reserves and surplus also. So equity share capital account, how much is for Vayu Limited? 3 lakh. Reserves and surplus is 70,000. Correct? So 3 lakh and 70 and this much. So totally how much we have to settle to these people? 4 lakh 20, which we are settling through equity shares. That is how it is getting tallied. Clear? Sometimes cash and bank balance also ledger will prepare. Final answer, whatever you are getting, cash or bank, it should be transferred to equity shareholders only. That also you have to remember. Clear? Hello? With this, what ledger is completed? In the books of selling company is completed. Correct? Now in the books of purchasing company, same entries rattle. Okay, this is what method? Merger purchase, because assets are not taken at book value, it is taken at revised value. So first entry is business purchase to liquidator, PC 530. Correct? Assets taken over at what? Agreed valued. Correct? And bank also, whatever is the 20 is taken. Gratuity they are taking at 20, 80. PDD, you remember, against the this they are creating 7.5%, that also we are taking, reverse the business purchase account. Clear? And when you settle, you are settling like this. Clear? How we got this, sir? 40,000 into 10. Correct? And 40,000 into 0.5. Clear? Premium 10 plus 5%. 10 plus 5%, don't write it as 15%. It will become 10 plus 0.5. Please take calculator and type. Okay, don't assume numbers and write it. And after this, accordingly you prepare balance sheet as we do every time. And in financial statements of a company also, it is important, whenever you are seeing the equity share capital, just write out of 1 lakh 40. Already our company is having 1 lakh, and for this Vayu Limited 40,000 shares we are giving, total 1 lakh 40 into 10, 40 lakhs. Please make sure you are writing this. Out of this 140, 40,000 is issued for consideration other than cash. Other than cash means for getting their assets, you are giving the shares now. So shares are issued not for cash, for some other consideration. So accordingly, you prepare the balance sheets, it will be tallied automatically. Clear? One important sum they have included in what? ICA study material, recent study material, new sum. It is very easy also, but be careful when I am teaching you this. Okay, just observe one point only, heroic point. Other and all easy. I have I will tell you very quickly so that you will answer it very quickly in exams also. Listen, following information of following information from balance sheet of X Limited. Okay, X Limited balance sheet it is 4,000 equity shares, 10% debentures, loans, state payables, general reserve we are having, building, machinery, inventory, trade receivables, bank patents, share issue expenses. Share issue expenses. What issue expenses? Share issue expenses, which should be taken to equity shareholders. Okay, listen. Y Limited agreed to absorb. Once again, the word absorb. Absorb means all assets liability. If they themselves say I am not taking over, leave that. Clear? Or else take all assets and liability. Y Limited agreed to absorb X Limited on the following terms. Y Limited would take over all assets, correct? Except, the word except if you see, okay, it is purchase. One more important point I'm telling you now, students will be confused. Y Limited would take over all assets except bank and patents. That's it. With that stop. Clear? Now, what they are telling is all assets I am taking over except cash and bank. Actually stop. All assets are taken over at what? Less than book value, 10% less. Come on, what is that? 10% less. Means except bank and patents. They did not take bank and patents. They are leaving it. From there itself we can conclude it is amalgamation in nature of purchase method. Okay. And the assets whatever they are taking, they are not taking over at their book value. They are not taking at their book value. From book value they are taking at 10% less. This is the first point. Many people what they are understanding is, okay, Y Limited took over all assets except bank balance, and the patents they have taken at 10% less is what they're thinking. Wrong. Clear? So except, the moment if you see the except, when they say bank balance and means this except is a continuation for this also. Clear? And means that the except is for expect, that is that and is there, no, this and is for this except is for this and also, means except bank except patent. After that they are telling I am taking this at a 10% less. Be careful with the sentences. Clear? Students, this type of questions are expected. Practice 2 times minimum. Clear? And goodwill is valued at 4 years purchase of super profit method. Hey, foundation RAM. Okay, super profit method average, goodwill calculation I'll teach you now. Assuming that normal rate of return is 8% on the combined capital, that is this capital and general reserve, it is nothing but capital employed. You remember in our childhood, correct? What childhood means, not 10,000 years back, now only. Clear? Sir, in goodwill when it comes to super profit method, how to find a super profit into number of years of purchase? Correct? Number of years of purchase. Super profit is different between average profit and normal profit. Average profit in this question they themselves have given. Correct? How much is the average profit? 62,200. Normal profit, you remember, capital employed into normal rate of return. Here normal rate of return is what? 8%. Correct? Now we need to know only capital employed. Capital employed we used to find asset side approach, liability side approach. Here we'll take liability side approach. Okay, va? Array, how much liabilities we are having, that we will see. 4,40,000. 4,40,000. Clear? So 440 into 8% if you get, you'll get average profit. So we'll check answer. Hello? We'll check. Listen to me. So how to find, come on, how to find it? Super profit is 62,200, capital employed into 8%, so 440. Capital employed is capital plus reserves and surplus. Clear? So 440 into 8% is how much? 32,500. So super profit is 27. So goodwill is equal to super profit into number of years. In some they have given 4 years. Therefore goodwill is how much? 1,08,000. This goodwill should be shown in what? Balance sheet also. It should be shown in what also? Balance sheet also. Here they have done many calculation. This will be comfortable for you for understanding. Clear? So this part we have completed and this part we have completed. Correct? Intangible asset. Correct? This is fine. Then what else they are telling? Sir, hero is that fellow. One more person is their hero, that he is the real hero. Okay, so first adjustment done. Y Limited is take over trade payables at book value. Therefore, indirectly they are telling there are how many liabilities? 1, 2, 3. 3 liabilities are there. They are taking over all the 3. Cleanly they are telling only trade payables. Trade payables only they are taking over, means not other liability. So if they are not taking over, who should settle? We should settle. The seller should settle. Clear? Everyone? So that's what they are asking. Clear? So Y Limited agreed to absorb X Limited. Therefore this fellow is purchasing company. This fellow is what? Selling company. Clear? Sir, what is the requirement also? We'll see, sir. Always that is important, no? Show the necessary ledger accounts to close which company? X Limited. Selling company ledger, like how we did. And prepare the balance sheet of what? Y Limited, the purchasing company. after takeover. They did not ask a journal entry. Clear? No journal entry, only balance sheet they're asking. Simple gana. Okay, listen. Okay, we will proceed further. Second also, we will remember, purchase consideration is to be paid in cash to the extent of 3 lakh and balance is paid in what are equity shares. The moment if you see, sir, balance means how much we don't know, no sir, then what is not possible? Net assets, net payments is not possible. We have to go to net assets method. Clear? Whenever if there is no clear picture as how much shares, how much amount we are paying to the shareholders, then we cannot apply net payments method. We have to apply only net assets method. Clear? Also, we will apply net assets method. Now only I thought you previous sum. Net assets means assets at agreed value, correct? Liabilities at agreed value. They have told, sir, certain assets they have taken over, sir, they did not give agreed value, correct? Revised value, nothing they are giving, sir. Then since they said assets taken over, then agreed value is nothing but the book value is assumed to be agreed value. Clear? Clear? So first let us find what net assets PC will find. Okay, PC. Just now I was telling PC. What is PC? Like under net assets method they are telling take assets at what value? Agreed value. Okay, goodwill as per the calculation how much we got? 1,08,000. Okay, tick. All the assets are taken at 10% less. You remember everything from the book value 10% less. Trade receivables also how much? 1,30,000 minus 10%. Every asset is taken over at 10%. They did not take cash at bank or something, and patents they did not take cash at bank balance or something. Correct? We'll check that. What balance they did not take? Bank. Okay, bank and patents. Apart from that, they have taken everything. Array, this is not asset weight. Clear? Ayo, share issue expenses. If it is showing balance, it is a fictitious asset. That should not be considered for PC calculation. Clear? So we will take all the asset. Liability also everything they have taken over, or okay, PC will do. Okay, assets taken over 1, 2, 3, 4, 5. Everything if you add, how much you are getting? 7,65,000. So assets taken over at agreed value. How much you are getting? 7,65,000. All the liabilities taken over, only trade payables. Only trade payables. So assets taken over minus liabilities taken over. What liability taken over? Trade payables. So that too at what value? 160. Other values are not, because they themselves they have given trade payables are taken over at what value? Book value only. So subtracted. Net assets is 6,05,000. So net assets 6,05,000, which is equivalent to PC. So net assets will become PC 6,05,000. As per the adjustment they have given in the question, 3 lakh will be given in cash. What is given in cash? 3 lakh is given in what? Cash. If 3 lakh is given in cash, balance will be given in equity shares at what? 125 per share. At what per share? 125 per share. Therefore, out of 6,05,000, 3 lakh will be given in cash. Balance 3,05,000 by way of what? Equity shares. How many number of equity shares we are going to give? 3,05,000 divided by 125. Therefore, how many shares we are going to give? 240, like not 2,440 shares we are going to give. This we have to show it in working notes to accounts, in fact. Clear? Clear? So if you go and see the notes to accounts, are able to see 242, that is 2,440 equity shares of 100 each. Okay, how much? 244. Clear? What 44? 244. Sir, but somewhere 3 lakh something is equity share capital should appear at what value? Face value. At what value? Face value. Clear? Balance will be shown in what? Premium. Balance will be shown in what? Premium. Able to understand? Clear? So balance will be shown in what? Premium. That is 244 into 100 will be in equity share capital. 2,440 into 25 will be shown in securities premium. It is beyond, like more than par, that's why it is shown like that. Clear? So we are done with what also, and similarly this will be fine. Clear? PC is also fine. Clear? Now I will teach you something very interesting point. I will teach. Listen. Are you all there? Listen. Okay. First, let us complete this fellow and we'll come back to this average liquidation. Okay, what is rest balance is average profit we are taken. Liquidation expenses amounted to 8,000. They did not give purchasing company paid, we paid. If nothing is given means what we have to assume is as if we have paid, means selling company paid. Okay. Y Limited sold prior to 31st March goods costing 60,000 to X Limited. That is purchasing company sold to selling company. Purchasing company sold to selling company. 60,000 worth of goods sold to selling company at what? 80,000. Out of 80,000, 50,000 was still there in the, which company? X Limited. X Limited is which company? Selling company. So, purchasing company sold goods to selling company. Okay, at what? 60,000 worth of goods they are selling it at 80,000. Therefore, how much is the profit? 20% is the 20,000 is the profit. Correct? Out of 80,000, whatever selling company we purchase, 50,000 still remain unsold. Clear? In that, what will be there? In that 50,000, inside that unrealized profit will be there. That should be removed. But don't think something else is there. Wait. Clear? Important point. That is what is a hero. Trade payables include 20,000 still due to ex-limited. Mutual owings. Mutual owings we know how to eliminate it. Correct? First we will finish selling company story. One by one we will finish. Ready? Agana? Selling company. Okay. Whatever is the assets taken over. Correct? Whatever is the assets taken over. Are you able to see? One second. I'll just draw it so that you'll know. Assets taken over. Okay, this is assets taken over, liability taken over. For assets taken over, liability taken over, you have PC. Correct? What about patents, sir? Patents they have taken over or not taken over? Not taken over. Bank they have taken over or not taken over? Not taken over. Whether bank account is transferred to realization? No, because it is already in realized form only. It is already in what form? Realized form. Patents taken over, anywhere in the question they have given patents taken over, nothing. Therefore, entire amount of patent is a loss. Loss should be taken to realization. Therefore, realization account debit to patents account. What is the entry? Realization account debit to patents account. Entire amount is a loss. So, entire 60,000, patent not taken over, 65,000 is a loss. Liquidation expenses, since they did not say anything, we have paid. Any expense should be debited. Realization expense, realization account debit to bank account expenses. Clear? So, this is also done. So, from the debit total, if you subtract these two, here we are getting difference. This is what are loss. This loss should be transferred to equity shareholders. This loss should be transferred to equity shareholders. So equity shareholders are able to see the loss. Share issue expenses, who have to bear? Equity shareholders has to bear. Clear? Equity shareholders are entitled for equity share capital and reserves at their book values. Clear? And these people are allotted by what? 3,05,000 the calculation. You remember? Kana? Similarly, bank balances will be there. Na, kana? You will prepare bank balance also. Opening balance is given in the question. Correct? Correct? Realization expenses we paid. The other out of three liabilities, trade payables only taken. What is left? Debentures and loan is left. So we have to settle. Since because they did not given the question, it does not mean liability is not settled. We have to settle, or else we cannot close the business. Everything is settled at what value? Book value. If any other value is given in the question, that should be taken. Clear, Ama? Hello? From from transferring company, we are receiving PC also in what? 3 lakh in cash. So increase the balance. So whatever is the difference, whatever is the balance in the bank balance should be transferred to what? Equity shareholders only. That's why we are transferring it to what? Equity shareholders to bank. Clear? Automatically it will be done. Closed. Clear? All other accounts, share issue expenses is a what? Fictitious. Transfer it to what? Equity shareholders account. Loan, all the loan account, opening balance should be settled. Liability, debentures should be settled. Clear? General should be transferred to equity shareholders. Clear? Share issue expenses should be transferred to equity shareholders. Clear? And transferring company, PC due, PC received. With this, everything will be done. Clear? Okay. Sir, you are telling no one hero is there. That hero I will tell you. So, selling company books is done now. Now, which company books is there? Purchasing company books. Correct? They are not asking journal entry, straightly ledger accounts. They are balance sheet. They are asking. Balance sheet 244 you would have understood. Securities premium would have understood. Only thing who you have to understand is, even you would have understood what are trade payables opening balance with the mutual owings you have to subtract. Similar to that, trade receivables also mutual owings you have to subtract. 20,000 as per the question subtracted. Correct? What you have to understand is this unrealized profit. What is that? This unrealized profit which you have to subtract from what? Reserves and surplus. Clear? How to do, sir? What is that? How to do, sir? Shall I teach you now? Listen. Entry is same. Reserves and surplus account debit to what account? Inventory account. Reserves and surplus account debit to what account? Inventory account. Clear? Clear? Reserve means what I am talking is this one. Okay. So securities premium they have given. You cannot touch it. P&L only you can subtract it. Done? Listen to me. Story starts now. What is that? Story starts now. Okay, listen. Sir, whenever net assets method is there, will there be goodwill capitalism or nothing? Most of the cases we will not have if you are not paying anything extra. Clear? If they say net assets along with that extra, you may get. But net assets you will not goodwill, you will not get goodwill or capitalism, because what is net assets that you are giving? Correct? So therefore goodwill capital reserve will not be there unless they tell something else separate for calculation of this sum they are giving. Previous sum, did you see anything like that? Correct? So they are telling. Clear? So 1,08,000 they are calculating. This is fine. Listen. This what is that? Unrealized profit. What profit? Unrealized profit. Are you all alive? Important sum. Listen. Actually, if you remember, inventories of selling company we are taking at 10% less. Inventories of what company ra? Selling company. Like all assets we are taking at 10% less means inventory 1,30,000 we are taking at 10% less. Correct? Not only that, straightly I'll come to the point because it is very important. We'll finish it off quickly. Okay. Trade pay. One second. I'll show you the number also. Here. How much is the selling company's inventory? 1,30,000. Correct? In that 1,30,000, okay, how much is still pending? How much is still due is 50,000 are still in what? They are lying as inventory. Now I will teach you something. Listen. Therefore, there is an unrealized profit in what? Closing stock of selling company. Are you all listening? Listen. Actually, closing stock of selling company, I'll write it as selling company. Closing stock of selling company is having a inventory or closing stock of say 1,30,000. Correct? In this inventory, out of 130, 50,000 amount is from which company's purchases? From purchasing company only. These people have got this. Clear? And when purchasing company is selling, how much they are selling? 60,000 worth of goods. They are selling it for what? 80,000. Therefore, when selling price is 80, there is a profit of how much? 20. Correct? Therefore, when purchasing company is sold, there is a profit of 20,000 in the entire stock. Now, out of this, how much goods are unsold as per the question? 50,000 worth of goods is unsold. Therefore, this will appear at what? Cost other than cost. Other than cost. So, in this, how much is the unrealized profit that is included? How to find this? When selling price is what? 80, profit is 20,000. And out of the goods sold, how much is remaining unsold? 50,000. Which is at what value now? Selling price only when we amalgamate. When I amalgamate, it will be at what? Selling price only. So what I should do is, in this 50, how much is the profit included? How much is the profit is there in this? How much is the profit is? 50 into 20 divided by 80. How much is unrealized profit? 12,500. Actually, what we used to do is 12,500 only we'll subtract from the reserves and stock. Correct? But there is one twist in the question. Correct? They are telling, array, correct. You have sold some goods 80,000. Inside this 80,000, 20,000 is the profit. But out of 80, this fellow is out of 80. Whatever you sold, 50 is unsold. Correct? Sir, but the stock is what? 130. No, sir. Accountancy is asking whether always he'll purchase from, purchasing company. He can sell, he can purchase from others also. He can purchase from others also. He can purchase from what also? Others also. Yes or no? So, it means out of 1,30,000, he would have, whatever is the closing stock that is pending, 50 is closing stock which is purchased from purchasing company, from us purchasing company. Balance 80 would have been from the other companies. I will write it as others. Correct? Now question is, we don't know the pricing of others. Leave it. But when I'm amalgamating, I will bring this inventory also in my books, purchasing company books. Can I show in my inventory of purchasing company plus 50 also I will show, or it is a misleading information? It will be a misleading information because it is at selling price. So we have to eliminate what from this? Unrealized profit should be eliminated. Therefore, in 80, if 80,000 is the selling price, profit is 20. If 50 is the selling price, what is the profit? 12,500. Accountancy says subtract 12,500 immediately. Subtract 12,500 immediately. Correct? So what we will do, out of one motivation, we will subtract 12,500. Correct? That 12,500 is correct, provided what information is not there is all the inventory. See, generally you have to subtract 12,500, but what we have done is we have taken all the inventories at book value, or inventory itself at the time of incorporating in our books, we have taken at 10% less. We have taken everything at less. We have taken everything at what? Less. Listen to me, Kana. Important point. Listen. Okay, so they are telling, did you incorporated the inventory when you are passing the journal entry, whether you incorporated 1,10,000 or 10% less, whether it is 1,10,000 or 130,000 inventories as per the question. That alone I'll check. Wait. Inventory is 110. Sorry, what is that? Inventory is 110. Therefore, they are telling, array, out of 110, correct? Listen, I'll write the numbers. Okay, out of 110, Okay, 50,000 if it is from the purchasing company, 60,000 you would have bought from others. Leave the others. Others pricing is not important. I have to include. See, from others, if you get, even if he's selling is even the others are selling at selling price. For us it is cost. For my selling company is also what. For him also it is cost, for me also it is cost. Mutual owing is this only. This is what is the stock I have sold. When I am including, I should not include the selling price. I have to subtract the profit, because for us as a team it is unrealized. Correct? So I have to subtract 12,500. But accountancy says, array, inventory value is what? 1,10,000. You can subtract 12,500. Wait. But my question is whether you have taken inventory at book value itself, or you have taken the inventory itself as 10%. Inventory itself you have taken at what? 10%. Therefore accountancy is asking, arrays, listen. You are telling the selling company inventory or including. Correct? What is the selling company's inventory? 1,10,000. In that, how much you sold? 50,000. How much is the closing stock from others? 60,000. When you are incorporating in your book itself, are you valuing them at full book value, or you are feeling that and all they cannot sell, sir, 10% less only they'll get? Yes sir, 10% I reduce, sir, because I know they cannot sell it at that 1,10,000. That is whatever we sold, sir, in the 10% I thought it cannot be realized, and whatever others sold 10% we cannot realize. So what I thought is realizable is only 45 and 54. So that's why 99,000 we have recorded at the time of recording what? Books. Correct? So 1,10,000, 10%, which I am splitting into 2, 50 and 60, 10% reduced. So I valued less. Correct? I valued less. Now accountancy is asking, oh, already in the inventory, already in this 50,000 you have reduced how much? 5,000 at the time of recording in the books. At the time of what? Recording the books. Correct? So accountancy says, array, I thought 50,000, in this 50,000 unrealized profit is 12,500. So 12,500 is what I have to subtract. Correct? In that, already at the time of amalgamation incorporation itself, at the time of incorporating the assets, you already subtracted how much? 5,000. If you have already subtracted 5,000, what is the meaning of that? Means 5,000 you cannot realize. Now accountancy sees something differently. Oh, okay. Totally unrealized profit is 12,500. Correct? Out of 12,500, already I have subtracted, because of this mutual owing, how much I have subtracted? 5,000. How is this? 110. I have subtracted totally 10%. I am writing it as 99,000. That 99,000, extraction, that 99,000 breakup I am writing. How 99,000 is? I would have sold unsold, others would have sold unsold. When I am taking itself, I came to know I cannot realize this 10%, I cannot realize. Clear? So how much only I can realize? 45 and 54. So I am showing in my books as what? 99,000. Correct? So 1,10,000 is becoming 99. 1,10,000 is becoming what? 99,000. Correct? So total I am decreasing. Means in my 50,000 stock, I know there is going to be unrealized profit of 12,500. When that is maximum decrease should be 12,500. In that, already how much I have subtracted at the time of valuation? 5,000. Once again you will subtract 12,500, or maximum 12,500. In that, already 5,000 subtracted, 5,000 already subtracted. Correct? So out of 12,500, no doubt you have to subtract 12,500. But question is, when you are bringing itself, you have subtracted and you are bringing at 45. Means already you have subtracted 5. Still how much yet to be unrealized? Once again 12,000 if you subtract, it means you are telling 17th. If you subtract 12,500 once again, correct? They are telling already you bought at 45,000 only. If you subtract 12,500, it means 5,000 you are subtracting, 12, totally 17,500 you are subtracting. But whereas unrealized profit itself is 12,500. Correct? Therefore they are telling total unrealizable amount is 12,500. Already at the time of taking itself, you said 10% I cannot realize. Correct? So 5,000 gone. So out of 12,500, 5,000 already I subtracted at the time of incorporating. Now yet to be subtracted how much? 7,500 is the final unrealized profit which I have to subtract. Therefore, when I have to subtract only how much? 7,500, because this 99,000 includes what and what amount? 45,000 from our sale inventory and from others. Means already 5,000 unrealized I have subtracted. Now I have to subtract only 7,000. Then only that 5,000, 7,000, total 12,500, unrealized I am showing. That's why I am subtracting only 7,500. Clear kana? After this, everything line by line line by line you have to add. With this, what is done? Amalgamation is completed. What is completed ma? Amalgamation is completed. When it comes to PC calculation, okay, quickly I'll run through the PC calculation. You can calculate PC, okay, once PC is done, everything is done kana. Okay, there are 4 methods of calculating purchase consideration. Okay, one method is called as lump sum method, where they themselves they'll give this is what is the amount I paid, take it and enjoy. That method is called as lump sum amount. Correct? But most of the cases they will not give lump sum method. They'll give what net payments method, net assets, intrinsic value. Net payments means whatever we have done from the morning, what exactly we paid to the equity shareholders, preference shareholders, what we paid, that will be given. So that will be taken for net payments. When net assets method we are following, where net payments method we are not able to apply, that time only we will follow what? Net assets method, as we did in the last cases. You remember one sum 8% of the, see for example this sum and all net assets, I would have given some sums to practice also. Clear? So what we pay to what? Equity and preference only we are taking. So equity, whatever you are paying, whether you are giving equity shares or cash, that should be considered. Okay. So similarly, what you would pay to debenture holders, that will not be considered for the PC calculation. Clear agana? So all the ICS study material sums also I have included for easiness of doing the sums. And Nil Limited and Gagan Limited is what I was telling when I was doing that ratio sum. You remember kana? 8% where we have to allot debentures in such a way they are getting only this much. Correct? This sum is net assets method. Listen, see, Neil and Gagan Limited are amalgamated to form a new company. So 2 companies are liquidated to form a new company. Clear? These are the information they are giving. And purchase consideration discharged by issue of 24,000 equity shares in the proportion of the profitability. There we saw 3 years average profit we saw. Correct? Here they did not even use the word average profit. Correct? Just they are telling the profit. So take the total of the profit. See the linings actually. Whether they are telling profitability or average profit. So if it is average profit means like that sum. Generally they are saying proportion of profitability means don't do averaging and all. So 2 years profit they are given, 2 years. What is the total? 475, 525. So whatever is the 24,000 equity shares we have to distribute now, it should be distributed in what ratio? 475 to 525. Clear? So what are the things they are giving is Neil and Gagan Limited have revalued. Correct? Plant and machinery building they have revalued. This is the value. Profits for the last 2 years also they have given. Clear? And also issue 12% preference shares of 10 each fully paid at par to provide income equivalent to 8% of net assets. Same question, 8% means first you have to calculate capital employed or net assets in that 8%, whatever income you are getting. Correct? Take that income. Their debentures, here preference. Only difference is that. Clear? Shall we do this also? Listen to me. Point number 1. Okay. First we have to see this 24,000 equity shares by the new company, whatever is the, that's a company, Sun, Neptune, Jupiter, that's some. So assume we are the new company. Okay, we are going to issue only 24. That 24,000 should be given to Neil and Gagan in this ratio. Correct? So the 24,000 will be given to Neil and Gagan in what ratio? 20, what is that? 475 is to 575. 475 is to what? 575. Therefore Neil will get 11,400 shares and Gagan will get what? 12,600 shares if you divide in that ratio. Clear? Okay, now story. Sir, that 8% story and all, no. First we have to calculate capital employed and net assets. How to find capital employed and net assets? Net assets means whatever assets we are taking over, agreed value, and liabilities at agreed value. So they themselves, they are given revalued amounts of plant and machinery building. So take 525, 775, 675, 648. Take these values and one more assets we are having. Okay. Current assets 163, 158, 600. 163, 158, 600. Current liabilities as per the book values you take. Add 3, subtract current liability, you will get net assets as this much. So 840 and 924. Okay. So 840, 924 is the capital employed or net assets. In this 8% is the income they are expecting. So 8% means how much? 67,200 and 73,928%. Clear hakana? Okay or not okay? Sir, okay. Now my question is how many preference shares I have to give? Their debentures kana, here preferences. So the difference should be there. That's why I have given this question for you people. The new shares to be issued is what percentage? 12%. So I am expecting an income of what? 67,200 by way of what? Preference shares. Now preference shares will fetch me how many percentage? 12%. How many preference shares of 12% each I have to give so that the preference dividend or income they will get how much? 67,200. So number of shares into 12% 50,000 into face value. Correct? I need number of shares. So number of shares is equal to take everyone that side and you'll get what? 56,500. The 56,000. Clear? Same like this Gagan also you do. How to do it? Tell me. 60, that is 73,920 into 100 by 12 into 1 by 10. You'll get what? This value you'll get. So how many shares we are going to, how many preference shares we are going to give to NE Limited? 56,000, 61,600. Clear? Therefore, PC calculation is equal to each equity shares is given at what value? 25. Preference shares are given at 10 at par only. Clear? So equity shares for NE Limited, Gagan Limited. Correct? 11,400 into 25, 12,600 into 25. This we will get. Preference shares 56,000 into 10, 61,600 into 10. You will get this values. Clear? This is one of the good sum, and all other sums are easy. These are all IC illustration sums. Just pause it and you can see this also. Very easy calculate. 4,000 into 10. This I have done in big question itself. Okay, cash also will give, preference shares also will give. Similarly for equity share also, cash as well as preference shares will give. Clear that question. Fractional shares I will teach you. Listen, a purchasing company has agreed to issue one share of rupees 10 each, 7 called up, for every 3 shares. Okay, for every 3 shares we are going to issue what? 1 shares. Find out the PC if there are 1 lakh equity shares in vendor company. The purchasing company market price is quoted at what? 21, and we are issuing at 21. Okay, how to calculate? How to calculate PC? We know that okay, there are 1 lakh equity shares. How many equity shares are there? 1 lakh equity shares are there. 1 lakh equity shares. Once again, how many? What is the division? What is the exchange ratio? 1 lakh shares you are having. For every 3 shares, 1 share I am going to give. Correct? Correct? So, into at what value I am going to give? 21 I am going to give. So, if you do this 2, 1 lakh shares into 1 by 3 means how many shares you are getting? 33.3, correct? 33,333.3333, something will get 33,333.3333 you will get. Correct? Can we issue shares at fractions? No. So, how to do this is for 33,333 shares, for that we will issue shares of 21, which will get it as what? 6,99,993. Correct? Correct, sir. For fractions, what we have to do? For fractions into 21, how much you'll get? You'll get somewhere 6.99, which is rounded to 7. So total PC will be how much? 7 lakhs. This is what you have to do for what? PC calculation. Remember, whenever fractions are getting, we have to check whether it is intrinsic value based question or not a intrinsic value based question. If it is intrinsic value, you have to take intrinsic value. Clear? Even market price is given, you have to take what? Only intrinsic only. Sir, it is not intrinsic value question, sir. Then check for market price. Then multiply it with what? Market price. Sir, market price also not there, sir. Then check whether if you are having issue price. Issue price is there, sir. Then multiply with issue price. Issue price also not there, sir. Then you have to take the face value. 100% hierarchy. Intrinsic value means first preference to intrinsic, even though market price is given. Clear? Even if market price is available, if intrinsic value based question means you have to use what? Intrinsic value. Sir, intrinsic value nothing is there, sir. Then use market price. That also not there. Issue price. That also not there. Face value you have to consider for the calculation. This is how net payments. Net assets also, where you are not able to apply net payments, we are not able to know how much we are going to pay, sir. How to identify net payment methods we are not able to apply, sir. You remember in the sums we did, we are giving cash 3 lakh and balance will be issued in the form of shares or required number of shares. Balance, gilance and all, if you see, it is what? Net assets, because balance to know, we have to know how much is the net assets, and net assets will be equivalent to PC. Accordingly, you have to do. This sum is what? Net assets method. This sum is what? Net assets method, market value, everything as per whatever agreed value. See, net assets method, all assets correct are taken over at agreed value, liabilities taken over at agreed value. Sometimes they'll say taken over, observed, something like that, but they will not tell agreed value. Take the book value, get the net assets, that will be equivalent to PC, and that PC is both for equity as well as preference. Clear? At the time of calculating net assets, don't consider what are fictitious assets. Don't consider what assets? Fictitious assets. Sometimes unrecorded asset liability will be there, that will be taken over. That also you can consider. Clear? That is also one of the good sum that you have to remember. Clear? And this sum also, I'll just hold it. Okay, this sum A limited, I just hold it, you will understand. Okay, just pause it, take screenshot and do the answers. It will be easy also. Last point, last discussion for us, intrinsic value method. Sir, there will be, assume we are selling company kana, we don't know how much only to ask as what PC. Some people will be there, no, we don't know how much to put to price only. Then accountant is giving one solution. Array, you find first your real value of the share. How to find real value of the share? Take all the assets at realizable value. Take all the outside liabilities at settlement value. So whatever number you get, no, that is what we'll call the net assets or net worth available for preference and equity. From that, settle the preference shareholders, whether you are paying at para, premium, settlement value separate. Then whatever amount you are having, that is the net assets available for equity shareholders. So for example, sir, I am having what? 50 lakhs. Okay, 50 lakhs is the all assets realizable value. What assets are? All assets realizable value. Outside liability settlement values 20. Therefore, what is the net worth available for preference and equity is 30 lakhs. Clear akada? Out of that, assume preference shareholders, we are paying total along with premium, we are settling 19 lakhs. Okay. Assume we are settling 11 lakhs. Assume we are settling what? 11 lakhs. 10 lakhs we have to pay, sir. Premium 1 lakh. So totally we are paying how much? 11 lakhs we are paying, sir. Therefore, what is the net worth available for equity shareholders? 19 lakhs. So 19 lakhs is available to the equity shareholders. I am asking how many equity shareholders are there? 1 lakh equity shareholders are there. Correct? Array, your worth of the company is 19 lakh. Totally how many number of equity shareholders are there? 1 lakh. So 19 lakhs, if I divide by 1 lakh, each person will get how much real value? Each person will get 19. That 19 is called as intrinsic value or real value or true value, inherent value, we'll call it as. Correct? Based on this, you'll ask. Okay, then selling company is okay, sir, understood. Every time when I am confused, first I have to find my real value. How to find real value? All assets at realizable value minus all liabilities. That is outside liabilities at settlement value. You'll get net worth for preference and equity. From that, you subtract what? Amount payable to preference shareholders. Whatever you get, that is the amount available for what? Equity shareholders. So with that, if you divide by number of shares of that company, you will get what? Equity shares. So sir, my company is having 1 lakh. In question also they are giving, see, if they don't give also, you know how to find now. Correct? In question they'll give 1 lakh equity shares are there. Intrinsic value is 19. Therefore, how much is the PC you have to ask the selling company? 1 lakh shares into 90 lakhs you have to ask. This who should settle? Purchasing company should settle. Array, listen. Purchasing company should settle. Correct? So PC is nothing but, first listen whatever I am telling. PC, how much selling company should ask? Number of shares in the selling company into intrinsic value of selling company. Of what company? Of selling company. So this is the PC. This PC will be settled by who? By the purchasing company, the transferee company. Correct? By the transferee company. When transferee company is settling that 19 lakhs, we are purchasing company, we are settling 19 lakhs, means we have to give our shares. Correct? Therefore, when I settle that 19 lakhs, when I am giving my share, correct, I have to divide by my intrinsic value per share. I have to divide it by what? My intrinsic value, assume if it is 38, I have to divide by 38 and I have to give number of shares like that. Clear? For example, 50,000 shares. Clear? When I give number of shares to be issued by the transferee company is nothing but PC divided by intrinsic value of transferee. When I am giving my shares, it should be divided by my, then only I know how many number of my shares I have to give. Correct? Never divided by what? Intrinsic value of what? Selling company. If you divide by intrinsic value 1 lakh shares, you'll give. If you don't know accountancy, if you do divided by what? 19 lakhs are okay, our share will divide by intrinsic value of selling company. 1 lakh shares if you give 1 lakh shares today itself, if you go and sell also 1 lakh into 38, you'll sell 38 lakhs, you'll get. Array, PC itself is how much? 19. If you wrongly calculate the shares, you may end up giving more shares, means what happens? You will get more amount. Correct? Our PC itself is 19 lakhs. Why are you dividing by 19 and bringing 1 lakh shares? 1 lakh into, if he sells it 38 lakhs, why you want to do such things? Correct? So right thing is what? It should be divided by number of shares to be issued depends upon what? Intrinsic value of the selling company. To find the PC, this may be the answer. Correct? To find the PC, come on. To find the PC, number of shares to intrinsic value of selling company. But number of shares to be issued is equal to PC divided by what? Intrinsic value of purchasing company. So to put it like this, listen to me, Kana. To put it like this, number of shares to be issued, last point to listen. Number of shares to be issued is equal to, okay, number of shares to be issued is equal to PC. How did we get the PC? PC is nothing but what? Number of shares. Come on, what is that? Number of shares of selling company into intrinsic value of selling company it should be divided by what? Intrinsic value of transferee company. Intrinsic value of what? Transferee or purchasing company. Clear or not clear? So 1 lakh equity shares, 19 they are asking, that should be settled by our share. Correct? Therefore, 1 lakh into 19 divided by 38. This only we'll call it as what ratio? Exchange ratio. Therefore, intrinsic value method can also be called as what? Exchange method. Clear? Or exchange ratio they'll ask. Exchange ratio is nothing but what? 19. 19 means intrinsic value of what company? Selling company. 38 means what? Intrinsic value of purchasing company. Therefore, exchange ratio is nothing but intrinsic value of selling company, that is transferor company, divided by intrinsic value of transferee company. That is intrinsic value of transferor company is to intrinsic value of transferee company. ಅರ್ಥమైందా ಎವ್ರಿವನ್? ಪುರ್ಜುದಾ? ಅರ್ಥ ಮಾಡಿಕೊಂಡಿದ್ದಾರಾ? Clear agana? So that is how we have to do. Clear? That is the logic behind the ratio. Clear? How the exchange ratios we are having. One sum I will take up, with that we'll wind up. Okay, others and all you can aram say do everything, you will get the answer. First to practice the sums whatever I taught you, then you do the balance sums here. Clear agana? Listen, the following are the balance sheet of Pratiksha and Nidhi Limited as on 31st March. Balance sheet of Pratiksha Limited and Nidhi Limited they have given. Okay, share capital everything they have given, assets they have given, everything is fine. Pratiksha Limited, okay, agrees to take over this company. Okay, Pratiksha is the purchasing company, Nidhi is what? Selling company. Pratiksha Limited agrees to take over Nidhi Limited. Find out the ratio of exchange of shares on the basis of book values. Okay, so whenever they're asking exchange ratio means that we have to find what value? My intrinsic value. What is intrinsic value? All assets at realizable value, all liabilities at settlement value. Correct? So for Pratiksha Limited as well as Nidhi Limited we will take, since nothing is there. Correct? On the basis of book value they are telling, no, so we have to, that is assumed to be the value. So fixed assets, investments, current assets. Fixed assets, investment, current assets. What are the liabilities they are having? Only outside liabilities. Don't take everyone. Clear? So take only current liabilities, debentures. So current liability debentures you will take. You will get amount available for equity shareholders. Amount available, everything are values. Amount available for equity shareholders. Same like this, Nidhi Limited also add and subtract these two. You'll get, this is not 150, it is 50, it is only 50. So you'll get 180. You'll get what? 180. Clear? So how many number of shares we are having? 20 lakh shares. See, here we are having 9 lakh shares. So divide this by 20 lakh shares, divide this by 9 lakh shares. Correct? 600 divided by 20 lakhs comes to 30 rupees. 180 divided by 9 lakhs comes to 20. Clear? Everyone. Therefore, intrinsic value of Pratiksha, intrinsic value of Nidhi Limited. Correct? Therefore, exchange ratio, now only I thought you know, exchange ratio is equal to intrinsic value of what company? Transferor company is to intrinsic value of transferee company. Transferor 20, transferee 30. Therefore, 20 is to 30, 2 is to 3 or 2 by 3. With this, we have successfully completed what? Amalgamation revision exhaustively. Clear? These sums are also super duper easy sums. Same exchange ratio we have to apply and get the answers. Clear? Okay. So, aram se practice it. All the notes it will be available. Rock it off. Finish it. Make sure after taking the printout, whatever sums you are seeing, you are writing it very clearly. Super duper questions. Everything is masterpiece questions. Okay. Please practice them very well. You will score highest mark. Practice this in the same flow, in the same way. Practice continuously. You will be getting super duper marks. And let me know how many of you are also waiting. How was the class? You just commented. And also let me know how many of you are waiting for consolidation and branch accounts in the comment section. We will meet once again back with a new chapter. Thank you so much, Kana. Keep rocking.